These are all the best trainings I've done on IUL and cash value life insurance, so enjoy. So when it comes to life insurance, it's pretty much broken in two different categories. You have term life insurance and you have permanent life insurance. Term life insurance is pure insurance, meaning it has no cash value at all, only a death benefit. And typically these policies last anywhere from 10 to 20 years. And when that specific time frame is over, your policy ends. And because of that, term life insurance is extremely affordable. So it's pretty straightforward. Now, unlike term insurance, permanent insurance is designed to last you for the rest of your life. And that's considered to be until age 100 or age 120, depending on the policy. And that's why they call it permanent, because term is temporary and permanent will last you till the day you die, just as long as you pay your premiums. Another thing that permanent life insurance has is cash value. And I'll be taking a deeper dive into exactly how the cash value works based on this specific policy. Now, when it comes to permanent insurance, there are several types you can choose from, but again, for this specific video, we're going to focus on Index Universal Life, or IUL. Now, the first thing I want to clear up is that Index Universal Life is not the same as whole life insurance. And that's one of the biggest misconceptions I always run across. I hear these two policy types used as if they're the same thing, but they are completely different. And I'll make a separate video specifically on whole life. That way, once you watch that video and then watch this video, you'll have a clear understanding of all the similarities and all the differences, because there are quite a few. And I know for some of you, the IUL may be something that you just recently heard about or just recently decided to learn about, but it was actually created back in 1997. Ironically, the same year the Roth IRA was created. And I say that because if you look online, you'll find a ton of articles comparing the two products. And I'll probably do a future video on that as well. So when it comes to the basics of IUL, here's exactly how it works. The policy has what's called a premium payment. And that's just the terminology used when you send your money directly to the insurance company. Now, these premium payments can be done monthly, quarterly, semi-annual, or even annually. And when the insurance companies receive these premium payments, the first thing they do is deduct any costs associated with the policy to cover that month. Then any money you have above the cost of the policy is what lands inside of your cash value. And your cash value is just an internal savings account inside of your policy. So it's money you'll have access to in the future if you desire. Now, when it comes to the cash value of an IUL, it's very important to understand the main goal is to capture market appreciation while eliminating downside risk. So here's how that works. Typically, your IUL will have two different cash value accounts. One is an interest-bearing account that generates a fixed rate of return, and that's often referred to as the general account. So that means your cash value will earn interest credit based on a fixed rate of return. For example, if the fixed rate of return was 3%, you know exactly what you'll be earning for that entire year. And the other type of cash value account tracks one or more market indexes. And a market index is something like the S&P 500. And the S&P 500 represents the performance of about 500 large cap companies in the US. So usually all the big companies that you know by name are part of the S&P 500. And different companies will give you access to different indexes. So this cash value account doesn't link your index credits to a fixed rate of return, but instead the index credits are linked to the performance of whatever market it is that you're following. So here's an example of that. As the index you're following grows, your cash value will receive index credits based on the performance of that index up into a cap. So let's say that cap was 10%. If the net dividend index growth rate was 5%, then your index credit will be 5. And that credit goes directly towards your cash value. And if the index grew 10%, then your index credit would be 10% towards your cash value. However, if the index grew 15%, your index credit would still only be 10%. And the reason for that is that 10% cap that I mentioned. You have to understand that your index credits will never be more than your cap, regardless of how great the index performs. And for the most part, the cap is determined by whatever IUL company you use, because different companies have different cap rates. So that gives you a basic understanding of how you get growth inside of your cash value when it comes to IUL. Now, in addition to your cash value having a cap on the interest credits you can receive, there's also a floor that gives you downside protection against losses. And that floor is usually 0%, meaning if the index you're following stayed flat and received a 0% rate of return, you would get 0% interest credit towards your policy, which means you get nothing. Now, let's say the market crashed and did negative 10% for that same year. In that scenario, your interest credit will also be 0%. because no matter how poorly the index performs, you will never receive a negative interest deduction from your cash value because of that negative performance. So that's what's considered downside protection. And all your gains from previous years will not be affected either. So the interest credits towards your cash value can only go up or be flat at zero. It can never be a negative deduction from your account based on the performance of an index, which means you'll never see the market crash 10% and then see your cash value decrease by 10% because of that crash. So your cash value is protected from those losses. So now as you understand the caps and floors when it comes to the IUL, next I want to take an even deeper dive and tackle the number one question people have when it comes to Index Universal Life. And unfortunately, I see this question dodged by social media influencers, YouTubers, and even life insurance agents themselves. And mainly because to answer this question, you really have to understand how the IUL works. Because this part you can't fake. And that question is, how in the world is it possible to capture market appreciation while at the same time eliminating downside risk? It almost sounds too good to be true. And you might be thinking the exact same thing right now while you're watching this video. So if that's the case, I got you covered. So the quick and simple answer to that question is that the insurance company buys options. And that's how they're able to capture the market appreciation while eliminating the downside risk. But I don't want to leave you with just a simple, basic answer to that question. I want you to walk away from this video really understanding what's going on when it comes to the cash value. So let's first start by learning what options are and how they work. So options are contracts giving the owner the right to buy or sell an underlying asset at a fixed price on or before a specific future date. So an option allows you to buy something in the future if you choose to. So here's a really good analogy for understanding options. Let's say you want to buy a house for $300,000, but the market seems a little shaky, it's a little unstable, so you're not really sure what direction the housing market is going to go in. I mean, the last thing you want to do is buy a house and then have the housing market crash on you. But at the same time, you don't want to miss out on the opportunity to buy, and then you see the house that should have been yours start to appreciate and increase in value. So you're pretty much torn between the two ideas. But what if there was a way for you to look into the future and base your decision on what you know is going to happen for sure? Well, options don't really do that, but they get really close to that. Here's what I mean. Let's say the seller allows you to buy an option on that property for $5,000. And that option will give you the choice to purchase that home 1 year from now at today's price of $300,000. So now let's fast forward to a year from now, and we're going to assume that that house is now worth $400,000. Now, because you purchased that option, the owner is now legally obligated to sell you that home for that original $300,000 price. So you instantly walk into $95,000 of profit as soon as you take ownership of that home. So that option will be considered in the money because you made an instant profit. But now let's say over that same year's time, the house decreased to $200,000. With that option, you also have the choice to not purchase that home for $300,000, knowing it's only worth $200,000. So in that scenario, the owner still keeps the $500,000 you paid for the option, but you get to walk away with no other obligations. And that would be considered allowing the option to expire worthless. So that's the overall concept of how options work. It allows you the choice or option to purchase something in the future after you already know the price. So what the insurance company does is buy options on the index with a cap. And when the market is positive, the insurance company chooses to exercise those options because it's considered in the money. And those gains are what's used to credit your cash value. And if the index performs at a negative number, the insurance company does not exercise those options. They allow them to expire worthless because they'll never buy a negative performing index. And that's why you don't get any negative interest deductions when the market is down. So now, what about the money actually used to purchase the options? From the example, it seemed like that money would be lost, right? Which technically is true, but let me show you how it's done so you can see how it doesn't affect your cash value. Let's say you have a cash value of $10,000. That $10,000 is put inside the life insurance general account. And for this example, we're going to assume that general account is earning a fixed rate of return of 3%. So based on the math, that $10,000 is going to earn $300 of interest. Now remember, inside the IUL, there are two different cash value accounts. There's a fixed account and there's also an index account. So let's say for whatever reason you want your money allocated towards the fixed account only. In that scenario, you'll be credited $300, which will bring your cash value account balance to $10,300 at the end of that 12-month period. So that's how you get guaranteed growth if that's something that you're looking for. Now, let's say you want to choose the index option. Instead of the insurance company giving you the $300, they'll use that $300 as a budget to go buy options on the market index with the cap. And if that index performs well, those options become in the money. And again, that just means profits were made. And those profits are what allows you to earn those interest credits to your cash value up until the cap. And on the flip side, if the market index crashes or performs negative, the insurance companies just allow those options to expire worthless. But your original $10,000 is not affected because it literally was never touched. Only the interest earned was used as leverage to buy the options. And that's how you're able to capture market appreciation while eliminating downside risk. And having the flexibility of both fixed accounts and index accounts can be very useful, especially when it comes to your goals or market conditions at the time. Now, when it comes to structuring your policy, your goals are an important factor to take into consideration because you always want your policies set up to meet your specific needs. And one way you can structure an IUL is more for a death benefit focus. And this will be for someone that likes the way the IUL performs, they like the way the index is credited, but at the same time, they want a permanent death benefit, which means term life insurance wouldn't fit their overall goal. So the idea would be to get the highest death benefit possible while at the same time keeping the policy affordable. And what's considered affordable will vary from person to person. Now, when you get an IUL, your agent will give you what's called a policy illustration. This illustration will give you future projections on your cash value and your death benefit. So here are a few areas I want you to look at. I want you to look at the guarantee column because that'll show you the worst case scenario. And an example of a worst case scenario would be if the market were to crash every single year for the next 100 years straight. And I'm not sure the statistical odds of something like that realistically happening, but I'm pretty sure it's extremely small. But I want you to look at it anyway. Next, I want you to look at the fixed rate of return so you can see what that projection looks like. And lastly, look at a very conservative index example. And the reason I say this is because I believe transparency is very important in anything you do financially. And I also love the idea of under-promising and over-delivering, because I'm sure you won't be upset if the index credits are a lot higher than you planned them to be. Now, another way your policy can be structured is more for a cash value focus. And this is definitely the more popular of the two options. And it's the complete opposite of the first example. You're not looking for a high death benefit, you're actually looking for the lowest death benefit possible according to the IRS guidelines. And the death benefit amount is determined by how much you plan on putting into the policy. And the reason you want a lower death benefit is because that lowers the overall cost of the policy, which means when you put money in, less money is paying for the death benefit and more money is going towards the cash value. Because remember, all the money you put in above the cost of the policy is what lands inside of your cash value. So when you hear people use the term properly structured, this is what they're referring to. And that's a low death benefit with a high cash value focus. So I always recommend that you use a good and ethical agent to help you design these policies to meet your specific needs. Now, next, I want to go over how you actually access the money in your cash value. So when it comes down to it, there's two options you can use. The first is the withdrawal. And that's pretty straightforward. You just request withdrawal directly from your cash value. And most companies will just send you a check in the mail. But you must understand that any withdrawal above your cost basis, which is just what you put in out of your own pocket, will be subject to income tax. So because of the tax liability, this option is rarely used. I mean, it's so seldomly used that a lot of people don't even know it's an option for them. Now, the other way to get your money out is through a policy loan. Now, when you get a policy loan, you're not actually borrowing money from your own cash value. You're actually getting a loan directly from the insurance company. And what they'll do is they'll use your cash value as collateral to help secure that loan. And there are a few reasons why somebody would choose to take a loan instead of taking a withdrawal. And one of them being taxes. Because loans are not taxable, so it's a way you can access the money without getting hit with a tax bill. And the next reason are interest credits. Because remember, your loan is coming directly from the insurance company and not from your cash value. So because of that, your cash value is still able to earn interest because it technically was never removed from your policy. And the third reason is because you're able to pay back the loans on your own terms. You won't be hit with any required loan repayment bills or anything like that. If you want, you can pay back the loan in 5 years, 10 years, or even not at all. Which means if you were to die with an outstanding loan, what happens is the insurance company will pay themselves back from your net death benefit. Then whatever is left over will pay to your beneficiaries 100% income tax free. So the fact that you have two different cash value accounts inside of your IUL gives you two different loan options. The first type of loan you can use is a fixed loan. So here's how that works. So let's say you have $50,000 inside your cash value index account, and you decide you want to take a fixed loan for $10,000. The insurance company will be the one giving you the loan, and we're going to assume they're going to charge you an interest rate of 3% fixed. So what they'll do is take $10,000 out of your index account and move it to the general account. And that general account is earning a 3% fixed interest rate. And since that $10,000 was moved from the index account to the fixed account, that means your index account now holds $40,000. So because you're being charged 3% interest on $10,000 and at the same time you're earning 3% on $10,000, that creates what's called a zero net loan or a wash loan. And that happens when the interest rate you're being charged is the same as the interest rate that you're earning. So they pretty much cancel each other out. So this would be considered the most conservative way to take out a policy loan because everything that's going to happen for that year is predictable. Now the other type of loan you can get is an alternate loan. Now with an alternate loan, you're still getting the money directly from the insurance company, but they're going to charge you a higher interest rate. Let's use 5% for this example. Now here's why someone may be willing to pay a higher interest rate on this specific type of loan. Because with this type of loan, the insurance company is not going to move $10,000 from your index account and put it into a general account earning 3%. They're going to allow your cash value to stay exactly where it is, earning whatever interest credits come from the performance of the market. So here you have an opportunity to create an arbitrage or a spread on the actual loan. Because if the index credit produces 7% and your loan charges only 5%, you actually make a 2% spread. And that happens anytime the index credit is higher than the interest charge. And the potential for earning a spread is why this type of loan can be intriguing for some people. However, if the market were to crash or perform at a zero, you won't get any interest credits, but at the same time, you're still going to be charged that 5% for the loan. So in this case, you'll have a negative 5% spread. So pretty much the loan type you choose is dependent upon how you feel the market's going to perform in the future. And a lot of companies allow you to switch from one loan type to the next loan type every anniversary of that loan. So you don't have to be stuck in one loan type forever if you don't want to be. And as far as how soon you can take a loan from your policy, most policies allow you to take a loan after about 1 month. And that loan is based on a percent of your surrender value, not your cash value. Because for about the first 10 years of the policy, your surrender value will be a smaller number than your actual cash value. And that's part of the projected illustration that I mentioned earlier. So you'll be able to see the approximate surrender value each year of the policy moving forward. That'll help you manage your expectations and help you properly plan for the future. And just like any financial product, you definitely want to know what the downsides are. So I'm going to give them to you in no particular order. The first is that if you're looking for life insurance coverage, the cost of an IUL will be more than the cost of term life insurance. Mainly because term only lasts for a set amount of years, usually 10, 20, or 30 years, and then the policy is over. And term also doesn't have the cash value component. So side by side, term insurance will definitely be more affordable than IUL. The next downside is that if you're in an index account and the market performs flat or negative, you will not get any interest credit towards your cash value. Now you won't get any interest deductions either, but your account won't grow that year. Because remember, your cash value only receives interest credits when the market is up. So that's something you definitely want to be aware of. Next is the fact that your growth is unpredictable. Because since you're following the market, every year can be different. Actually, every year will be different. So that's why I mentioned to look at conservative illustration growth rates. Because that way, great years will be a bonus for you versus being a necessity for you. And I feel that's the safest route to go. Because you have things like interest rates, option prices, and market performance that determine your interest credits and determine the caps. Because the truth of the matter is you have some people that are very confident in the market and they believe the market is going to do a certain projection over a certain period of years. And then you have others that may not know how the market works at all. So the IUL is more of a middle ground between someone that's extremely aggressive and someone that's extremely conservative. Because remember, the IUL is designed to capture market appreciation while at the same time eliminating the downside risk. Let's be honest, no one likes to be stolen from, especially you. And you're here mainly because you want to make sure you're not being taken advantage of and not being stolen from, or you don't want to put yourself in a position in the future where you could be stolen from. Either way, I've got you covered in this video. So today we're going to talk about, does the insurance company steal my cash value inside of an IUL? Because the truth of the matter is, when it comes to insurance agents, They're broken into three different groups. So you have insurance agents that push whole life product, you have insurance agents that push IUL product, and you have insurance agents that push term life product. So three different insurance products. And essentially, they're in a competition with each other. So they kind of bash each other a lot. So what happens is they usually go out and try to point out flaws in the other product so that their product looks better. It's pretty straightforward. It is what it is. It doesn't matter if it's insurance, if you're selling burgers, it's always going to be some type of competition. And I'm all for it. I do believe it can be healthy to an extent because it does keep everyone in check. But when you start to mislead people, that's when I have a problem with it. Because essentially, when people are pushing their product, sometimes they are misleading, and that's why I do say it's good for someone else to come in and say, hey, I know they said that, but that's not true. But when they're saying something that's completely false, then essentially I want to make sure I jump in and straighten it out. And not that I'm Robin Hood or something like that, but I'm in a position where I offer all three and I focus on learning and knowing and sharing the pros and cons of all three so I can give you an honest opinion. So let's go over exactly what happens to your cash value when you die so you can see if the insurance company is actually stealing your money or not. So when you die, there's three different scenarios you can be in, and you actually decide which one benefits you the most when you're setting up the product. So first, we're gonna have an increasing death benefit. So with the increasing death benefit, this is what happens. So you have your death benefit, which is how much that pays out when you pass away. So in this example, let's just use $100,000 to make the numbers easy. So it's a $100,000 death benefit. Then you also have a cash value. So let's say your cash value is $60,000, right? So what happens is when you die in an increasing death benefit, it takes your $100,000 death benefit and it increases it by your cash value. So if your cash value was $60,000, then your death benefit payout to your beneficiary, which is income tax free, would be $160,000. So it doesn't matter if it was $80,000, if it was whatever is in your cash value gets added to your initial death benefit, and that's the amount of death benefit when you purchase the product. So there's always an initial death benefit. So you take that initial death benefit and you add the cash value, and that's your increasing death benefit. So you choose an increasing death benefit option, cash value plus your death benefit will pay out. So all of it pays out. So there's no question when it comes to increasing, because that's probably the most straightforward of the three that I'm going to cover. Cash value plus death benefit paying out is an increasing death benefit. So the second type of death benefit payout is the one that gets the most controversy, and that's a level death benefit. So with a level death benefit, that just means you decide you want to have a level death benefit. So if it's $100,000, that means when you die, you want that $100,000 to pay out to your beneficiary income tax free. You don't want it to increase, decrease, anything like that. You want it to be level. So in that scenario, let's say you have $40,000 you've put in out of your pocket, and let's say that $40,000 has been earning compound interest and it has grown to $80,000. Okay, you have $80,000 in cash value. You put in 40, it grew to 80. The 80,000 is your cash value, and the death benefit is $100,000. So in your mind, look at those three categories: what you put in, the actual cash value, and then the death benefit: 40, 80, 100. So when you die, $100,000 is going to pay out to your beneficiary. So outside looking in, it's easy to show that to a client that says, hey, you have $80,000 in cash value here. It says $80,000, but you have a death benefit of $100,000, but when you die, $100,000 pays out. That means the insurance company has kept your $80,000. It's very easy to say that, and it's very easy for someone to believe that, right? So, but that's not really how it works. So as you have that cash value, so because when you signed up for the product, you chose to have a level death benefit, that means you want your death benefit to be $100,000. So you have $80,000 in cash value. So what happens is, upon your death, they're going to use that $80,000 as a payout. So $80,000 is going to pay out to the beneficiary, and the insurance company only has to cover the 20. So you're giving the 80, the insurance company is giving the 20. Well, why would someone even want that scenario? So in that scenario, because your cash value is $80,000 and the insurance company is only responsible for 20, that means you're only paying for $20,000 of coverage. So that means the costs are dramatically decreased over time, because as your cash value starts to build up, the bigger your cash value, the less money the insurance is on the hook, because the insurance has to pay the difference. So regardless of how much cash value you have, they're going to have to add whatever needs to be added to it to make the payout $100,000. So if you have $20,000 in cash value, then they're going to have to come up with 80 to make sure that level amount of 100 that you requested pays out. So you're paying for that $80,000 of life insurance. But as your cash value starts to increase, the amount that the insurance company responsible starts to decrease. That means you're paying for less and less insurance over time, which dramatically decreases the cost of the policy. So it makes the policy more efficient, right? So it's real important to understand that. So when you die, your cash value is what's used first, and the insurance company is going to make up the difference, but that's okay because you're only paying for the difference. Now, if you're paying for $100,000 of coverage and they only gave 20, then yeah, that's a ripoff. But you're not paying for $100,000 anymore. As your cash value increases, you're paying for less and less and less, because the insurance company is only responsible for the difference between $100,000 and whatever your cash value is. So that's what you would set up in the beginning when you sign your policy, and that will be a level death benefit. So remember, increasing your death benefit plus your cash value. Level means you only want a certain amount of death benefit, so you're going to leverage your own cash value that hasn't been used and add the insurance company's difference to make it whole so that the entire $100,000 pays out to your beneficiary. So that is a very easy way to mislead a client, is to show them that, hey, you have $80,000 in cash value, you have a $100,000 death benefit, they're going to pay out the $100,000, and then they're going to keep your $80,000, right? Most people would believe that if it was told to them, because you're looking at the paper and it just makes sense from what you're looking at. But now as you understand how it works underneath the hood, well, you're not paying for $100,000. You're only paying for 20 or 30, whatever the difference is between your cash value and the death benefit. So it's lowering the cost, because insurance costs money. So you're lowering the cost, but at the same time, you're getting the ideal payout, which you wanted, which was the $100,000. Okay. Hope that makes sense. That's probably the most confusing of all of them, but I hope that makes sense. Then you have the third example, which isn't always used, but it is used in some companies, so I'm going to cover it because you may run across it. And that is a ROP. ROP stands for return of premium. So that means you're going to take your death benefit, the $100,000. So we'll use the example from before. You put in $40,000 out of your pocket. That $40,000 has earned compound interest and has grown to $80,000. And then you have your $100,000 death benefit. So with a return of premium, it's like level and increasing kind of bridged together. So you have that $100,000 that's going to pay out, but you have $80,000 in cash value. So you have $80,000 that can be used towards your death benefit, meaning the insurance company has to cover the 20, but you also want to include everything you've paid out of your own pocket. A return of premium. So I want to return on all the money that I put into this policy, which is the $40,000. So essentially $140,000 would pay out, because it's the 100 plus what you put in, which is 40. Now, how it pays out is how I explained. So you got your death benefit plus your cash value to equal the 100, and then you add the 40,000 on top of that to give you a return of premium. So that's usually like an option 3 or option C, but those are the 3 options. Now, which one is the best depends on your design and your situation. So there's not like a one size fits all. Like if you're trying to accumulate cash value, in most situations, the increasing death benefit is going to be the best option, because you get the full death benefit, meaning you can put in more cash value, because what you put inside your cash value has to be in proportion to the death benefit you're paying for. So we use increasing as you're accumulating. And if you stop putting money in, then you can always switch it from increasing. I don't want to say always, because not all carriers you can do that. But for premier carriers, you switch from increasing to level, because you're no longer funding the policy, but now you can level it off to make it as efficient, because now you can use that cash value, drive down the cost of insurance, and then the policy can perform even though you're no longer putting money in, because the insurance still has to be paid for. So now your cash value and the interest that your cash value is earning pays for the insurance on your behalf. So the insurance cost doesn't go away. It's just that the policy is so efficient, it could pay for itself and be self-funding on your behalf, right? So those are three different scenarios. And if it's still confusing, I understand, because this is probably one of the most confusing parts when it comes to life insurance, is how the death benefit pays out and where these dollars actually come from. But just know your cash value is always going to be used and always going to be utilized, and the insurance company is not stealing your cash value inside of an IUL. So based on the title of the video, I'm sure you have somewhat of an idea what this video is about. But let me tell you this, I'm going to put timestamps in the description box below. That way it'll be easier to navigate through this video, because I have no clue how long this video is going to take me to make. So let me give you a little backstory so you have an idea of where this video is coming from. So I made another video about IULs, just explaining what they are, how they work, and things like that. And someone made a comment about, hey, these are the 8 reasons why IULs are bad. And I replied back, letting them know they were misinformed. And I even offered to jump on a one-on-one Zoom call so I can walk them through and show them exactly why they are misinformed. So they chose to not take me up on my offer for whatever reason, and proceeded to go back and forth with me in the comment section. And that was leading nowhere, because it seemed like they had their mind made up as far as like what they believe the product is and how the product works. So based on some of the replies I received back, I got an idea that they didn't really understand how IUL actually works. So I kind of left it alone and figured like, hey, I would just make a video replying to all the different areas so then they can watch it and hopefully be educated. One thing I do know is they work for a company named Primerica. So if you're familiar with Primerica, or you know about Primerica, or maybe you had experience with Primerica, you could put it in the comment section so I can learn more about the company. I know they're an insurance company, but I don't know necessarily how they do business. So I would like to learn from you guys what you guys know about Primerica, and that way I can inform myself and learn more about the company, what they stand for. And hopefully the information that they were putting in the comment section isn't something that they learned from the company Primerica, but who knows? Like I said, you guys probably know more than I do, so I'll be looking forward to see your comments so you can let me know what were your experiences with the company Primerica. So let's go ahead and jump in so we can see if we can clear up some of these reasons that make IUL such a bad product. And by the way, I'm not here to push IUL on anybody. If you've watched my channels, you know I'm very big on comparing things, pros and cons. I believe there's no such thing as a perfect investment, but if somebody comments something and I know for a fact it's false, I'm going to clear it up. So in this video, it is going to be more of a defense of IUL, but at the same time, I always say you want to get a product or put your money in places that's going to benefit you and be in alignment with your actual financial goals. Just wanted to throw that in there before we get started. So the first concern was the first 5 years, no growth. So let's tackle that. So right here, what you're looking at is an actual illustration. And I'm not here to push a company, so I'll be blocking out the company and of course my personal information, but it gives you an idea of what the actual product looks like. So this person here, this is a female, age 30. We're starting off with the death benefit of $159,867. So that is the death benefit, and it is paid monthly. So the monthly amount going into the policy is going to be $500 a month. Okay, so that's where, if you look at this, the blue section, so you have the year of the policy, the age of the client that year, premium outlay, that is that $500 a month times 12. So it's going to show you an annual number going in. That's what that $6,000 represents. Now the accumulated value, that is your actual cash value. That's the column that's going to grow and earn compound interest. So you can see you put in $6,000. In this situation, $4,983 went to the cash value. So the difference between the two, I always say, was removed in the form of a cost of the policy, because there is a $159,000 death benefit you have to pay for, and the policy does have admin charges and things like that. So just know that difference between those two numbers, little over $1,000. So if you divide that by 12, you're looking at maybe like $84 or $85 a month in cost for that policy. So everything above the cost is what's going inside of this accumulated value. So year one, 6,000 goes in, 4,900 goes to accumulated value. Then you have the cash surrender value. That's just kind of showing you if you canceled the policy and walked away, or if you want to access policy loans or things like that, it shows you what's available. So you can see 100% is not available right out the gate. So you're losing maybe $200, $300 off the top if you cancel the policy right away, or if you want to take a policy loan. So you got your cash value, and just call this assessable value. Then you have your death benefit. So hypothetical interest rate. So I'm running this hypothetical rate at 5%. So I chose 5% because there's not too many people that don't think that the S&P 500 can do at least 5%. So your growth is determined based on following a market index. So I'm just going to use the S&P 500. So the S&P 500 is pretty much the top 500 companies in the US. Collectively, what they do together determines the performance of the S&P 500. So this account will mirror the S&P 500. So there's a cap and there's a floor. Cap means there's the most you can get annually. Floor is the worst case scenario. So for instance, let's say the cap is 10%, right? So caps can be, caps can be 10, it could be 12, it could be 15, but I like to use even number. Let's say the cap is 10%. That means if the market does 8, you're expecting an 8% credit towards your cash value. If the market does 12, then that means you surpass the cap of 10. That means all you can get is 10. So everything above 10 you don't get. Only 10% will be credited towards your cash value. So with that being said, it's pretty reasonable to say that this can perform at least 5%, right? Personally, I think it'd do better than 5%, but I like to show conservative numbers compared to what the S&P can do. So at 5%. So let's take a look at the first 5 years to see if our accumulated value is either growing or staying exactly the same in the first 5 years. So I'm going to pull up the calculator so we can look at this together. So we have 49.83. So that's roughly about what's going into the accumulated value every year. So if we add another 49.83, that gives us 9,966. However, the accumulated value is 10,221, right? So there's some growth, right? Because what you put in, it would only been 9,966, but there's more than that, so there's some growth. Let me add another 49.83, and we're at 14,949 plus 49.83 plus 49.83. So that's 5 years. So 24,915, and we go 1, 2, 3, 4, 5. At year 5, 27,544. So it looks like there was some growth. So let's subtract 27,544. So there's some growth. There's $2,629 worth of growth in the first 5 years. And again, this is assuming the market only did 5%, right? So this is a hypothetical number because the market moves every single year. The market can be more, it could be less. So this can be 8%, it could be 9%, it could be 3%. So it has to be a hypothetical number because you're not getting a fixed rate of return every single year. You're getting a rate of return that's going to follow whatever the market does every single year. So hope that makes sense. So question number 1, does it gain any cash value or does it gain any interest or any growth in the first 5 years? I would say the answer is yes. Mathematically, it says yes, and that's even at a 5% rate. So now let's move forward to comment number 2. So this one says you can only get the death benefit or the cash value to leave for your family. The company keeps one or the other. Who pays for 2 things and only gets one? So it's saying you only either get the cash value or you're going to get the death benefit, not both. Okay, so let's look at the illustration we're looking at right now. So we started off with an initial face amount of $159,867, right? Now, if we look at our death benefit column here, we can see that number is increasing. It's starting to get larger and larger and larger. Why is that? So what it's doing is taking your $159,000 initial face amount and it's adding your accumulated value, and that's what's going to pay out in the form of a death benefit. So let's check that out. So if we take, let's pull up our calculator again. So if we take 159,867 and then we add, let's do this year right here. So we're adding this policy year 9. Policy year 9. So here we go. Let's make it even. Policy year 10, right above the green bar. So we're adding 62,000 $620. That means that total, this cash value plus the death benefit is $222,487. Ironically, what's the death benefit in year 10? $222,487. So when you pass away, the insurance company says, okay, how much is the death benefit? $159,867 plus how much money is in the cash value? $62,620. Combine them both, and that becomes your death benefit that pays out. So you're not getting one or the other, you actually get both, right? You get your cash value plus the death benefit, which you can clearly see here, and it continues to go higher and higher and higher based on the value of your cash value growing over every single year. So I think that clearly answers comment number 2, where we can say that's debunked. You do not only get one or the other, you clearly get both. And if you're wondering how you do that, this is called an increasing death benefit. That's the actual title for it. Increasing death benefit means it takes your death benefit and it increases it by your cash value. So now let's move on to the next comment, which was the so-called strongest benefits immediately go away if you are late one time. So I'm not sure what he meant by the strongest benefits. I would say the strongest benefit when it comes to a life insurance policy is the death benefit. I would say the second strongest benefit is the cash value. So let's just look at both. Let's look at the death benefit. What happens to the death benefit if you're late one time, and what happens to the cash value if you're late one time. So in this scenario, let's say you're late. We're going to be late. I'll write an example. We're going to be late 5 years. So we're going to stop paying in the policy for whatever reason. We don't make a payment into the policy for 5 years. I would say that's pretty late. Would you say that's pretty late? Because not only are you late on one payment, you're late on every single month for 5 years straight. What happens to your death benefit and what happens to your cash value? Okay, so let's look at the death benefit first. So death benefit over here, it was $240,000 when we made our last payment in year 12. We didn't pay anything in year 13, but what happens? Our death benefit increased. What about the year after that? It increased again, and increased again, and increased again, and increased again. So it increased every single year, even though we did not make a payment. That's kind of odd, right? How did it do that? Because here's our cash value. So our cash value, right, because this is growing at 5%, at 5%, it's pumping out so much compound interest that it not only makes the premium payment for you, but still has enough money left over to continue to grow. And the growth of this cash value is what's driving up the actual death benefit. Because remember, it's a combination of the initial death benefit plus the cash value together is what pays out. So you can see that the policy pays for itself because you're clearly not paying for it. It pays for itself for 5 years straight and still has enough compounding to continue to grow. That's remarkable. And again, this is at 5%. So the comment said, if you're late one time, we can all agree. It doesn't matter if you're knowledgeable in insurance or you know anything. Common sense can tell you that 5 years is a lot longer. 5 years of not paying is a lot longer than one missed payment. And even though you didn't pay for 5 years, your death benefit was driven up and your cash value still was driven up. And that's at a 5% rate of return. If the market was doing better than 5%, then we already know it's going to do better than 5%. So I would say we pretty much covered that. So we know if you don't make a payment, if you're late, you're okay. Your cash value can take care of it on your behalf, but you still have that compound interest that's working for you that drives, one, the death benefit up higher and your cash value up higher at the same time. So whichever one he was referring to as far as like the strongest benefit, we covered the two strongest benefits, which were the death benefit and the cash value, and both got better even though we didn't pay into the policy. So now we're on comment number 4. And comment number 4 says the fees eat up all the cash by the end, so it cannot grow as promised. Cap rates suffocate the growth as well. So the fees eat up all the cash by the end, so it cannot grow as promised. So we're looking at this policy and we clearly put in $6,000 and there's only $4,900 that goes towards your actual cash value. So we know fees are included in this policy. So it's not like $6,000 you pay into it and your accumulated value says $6,000 and we got to calculate the fees later. The fees are already calculated into this illustration. So we're going to account for the fees. I'm going to show you what it looks like in later years. And cap rates suffocate the growth as well. If you're in a product that has a 10% cap and it's following, for instance, okay, let's say the product has a 10% cap, just to make it easy. Product has a 10% cap. It's following the market, which is no cap. If the market does 12, you're limited to 10. I think that's pretty straightforward. That's pretty obvious. The reason people are okay with that is because they like the fact that if the market went negative 20, they're locked in and they're not taking any negative credits because of the poor performance of the market. So you're not going to lose. Your account value doesn't go below zero if the market performs below zero. So you're like in that middle zone. So if this is the zone, if the market performs up here, you're only going to get this level. But if the market performs down here, you're not going below that level. So all your previous gains are locked in. So I think it's pretty straightforward on the second part where it says cap rates suffocate the growth as well. Yeah, you're limited to the caps. That's pretty obvious. But the other part was fees will eat up all the cash value by the end and can't perform. So again, we're using 5%, and we're going to assume the market only does 5% for, the rest of the life of the fund. So I'm going to fast forward through this policy. Okay, so let's start here. Okay, so here we have age 80. Age 80, I stopped the payments, right? You can stop the payments sooner. You clearly saw you can stop the payments sooner, but you can stop them sooner. You can continue to allow them to go, but I just stopped them at age 80, okay? So at age 80, we stopped the payments. There's $1.1 million in cash value if the market just did 5%. But remember, not only are we no longer putting money in, but fees are being deducted from the policy internally because the cash value is paying for the fees on your behalf. Let's see what happens if we go further out. So if we go further out, you can see the policy makes it to the final year, which is age 121. So you can see this is the last year of the policy, age 120. And at that point, $7.1 million is in there and it's still paying for itself. So remember, the fees are already baked in here, right? So, and again, this is assuming the market only does 5%. So I think that kind of clears up that response to number 4 regarding the fees eating up the policy, because it looks pretty good to me, right? So let's move on to the next one. Okay, so number 5 says it has never beat the market in 100 years ever. So let's get this cleared up. So we know by now that the S&P 500 has no caps. It's the stock market. It could go as high as it wants to go. But the IUL has caps. So IUL has a cap. So that means if the S&P does 18, you're not going to get the 18 in your IUL. But at the same time, if the S&P does negative 18, you're not going to take that 18% loss. So what I want to do is show you side by side what it looks like, and you tell me if the S&P beats an IUL every single year. Because think about it. Let's say we both had $1,000, and I had $1,000 aside my cash value IUL, and you have $1,000 in your brokerage account following the S&P 500. Let's say the market went negative 24%, right? If that happens, that means your account balance drops by 24%. If that happens to me, that means my account balance stays at no loss. So it stays exactly at $1,000. So I have $1,000, you have 24% less than $1,000. So if you take negative 24% compared to 0%, which one would you say performed better that year? Pretty straightforward. So yes, the IUL can outperform the S&P 500 if the S&P 500 has a negative year. Now, the S&P 500 operates on what's called a point-to-point. So a point-to-point means December 31st does not apply to all accounts, because if you open your account in April, the only thing that matters to you is April of the following year, because that'll be your 12-month anniversary. So every month there's a new anniversary when it comes to these policies because they're point-to-point. So I want you to look at a point-to-point schedule compared to the S&P 500. So you can see if the S&P 500 is going to dominate and beat an IUL every single year for 100 years. Okay, so right here we're looking at October 2006. So here you can see the S&P 500 that month for that period did 15%, 15.38%. So the cap happened to be 12%, so you got a 12% cap. So who performed better? The S&P 500 performed better because IUL was hit with the cap. So you can see how it works. If it beats the cap, you only get the cap. Here, the market did 11.61, so the S&P was able to match that. It did 6.91, it was able to match that. So you can see right here, the S&P did 25.35. S&P can't match that. It only could do 12, so the 12 is the cap. But this is now we're into 2007. But let's scroll up and take a look at what happens here. Some of you guys may remember what happened in 2008. So here, the S&P did -1%. So that means you got 0% in your IUL. So you're left exactly where you left off. Not a big difference. But then guess what? The S&P got worse and worse and worse. So now the S&P did -20. You got 0. -35, you got 0. -40.62, you got 0. Which account performed better? The -40% or the 0%? I think anyone can look at this and tell you 0% is better than -40%, right? So you can see all the way in through 2009, same thing. Then, okay, October 2009, S&P came around and finally did 9.42%. And guess what? You just unpaused and now you went up 9.42%. Then did 27 huge rebounds and now you're hitting the cap. You're hitting the cap, you're hitting the cap, so you can't compete with these. And then you fast forward again, you can see, you're getting some good double-digit rates of return. Then in 2011, there was a -2%. That time period, you had 0. Then from there, it did 16, you got the 13 cap. See the cap change or whatever, caps change. 13.35, you got 13. So you can see the S&P 500 can actually lose to an IUL if the S&P 500 performs at a negative number. So, but on the upside, yes, upside, the cap cannot compete with the upside. But to say that you will never beat the S&P 500 ever in 100 years is totally false. And I'm showing you exactly how it's totally false, because you can ask a lot of people that experienced a lot of losses in 2008, do they wish they had guarantees on their money at that point in time? And I can tell you the majority of them will probably say yes. They wish they had guarantees to protect from those 40% losses. So we got that cleared up. Now let's move on to number 6. There are 22 million millionaires in the U.S. and 1,700 new ones created every day. IUL have not created one of them. You have a better chance of winning the lottery than getting wealthy through IULs. Okay, so there are 22 million millionaires and not one was created by IUL. Okay, so I'm assuming you know exactly how all these millionaires were created. There's 22 million millionaires and you know exactly how all of them were created, is what you're saying. Everybody knows that's bogus. Nobody knows exactly how everybody built their wealth, right? Someone could have done it through real estate, they could do it through business, but to say no one became a millionaire using IUL, I challenge that strongly. Out of 22 million millionaires, nobody utilizes IUL at all. Not one person utilizing IUL. But the example we showed you, right? Let me go back to that example. So here, clearly we can see if somebody just was putting in $500 a month at 5% assumed rate, they'd become a millionaire at age 78, right? And if the market did better than that, it'd be a lot sooner. But let's just stick with the 5%. So I think you can create millionaires with an IUL, right? This is just $500 a month, right? They're just, let's say you just saved it for retirement. There's $1 million in their account. That means they are actually a millionaire. So there's no way for me to prove that not one of the 22 million millionaires used an IUL, but at the same time, there's no way for you to prove that they didn't. But I'm showing you how you can become a millionaire with an IUL at $500 a month, assuming a 5% rate of return. And technically, you can also become a millionaire through receiving a death benefit. So if there's an IUL that has a death benefit and you receive the death benefit, you could be on the receiving end of $1 million and become a millionaire from, a parent or somebody passing away. So that's another way I didn't even think about how you can actually become a millionaire through IUL. But just from accumulation purposes, you can see that it is possible through accumulating just from growth of your account. And just out of curiosity, I want to know, what are the chances of actually winning the lottery? And it says clearly it's 1 in 992 million. So you're telling me that I have a better chance of hitting the lottery than I do contributing $500 a month and assuming that the market's going to do a 5% rate of return or better. That just doesn't make sense. Okay, so let's move on to the next one. We're at number 7 now. So all of their illustrations ignore guaranteed examples. The only thing they have to pay you is what is in the guaranteed column. So let's take a look at a guaranteed illustration. Okay, so here we have 3 different columns. You have the guaranteed value, that's at 0%. That's assuming a 0% rate of return. You have this one's non-guaranteed at 3.25, and this one's the 5% that we've been covering this entire video. So those are the 3. So you got this section, and this section. So we're only going to focus on this section right here, which is the guaranteed value, which is 0%. So here we're investing into the accumulated value, and that's your cash value. Surrender value, same thing. There's your death benefit increasing. Here we're looking at another group. So this is age 40 through age 59. Same thing. Your accumulated value is there's still money there. I mean, nothing compared to, what's at a 5% rate of return, but there's still money there. And this is assuming no interest. Okay. Okay. And here we go here. This is, to age 79. So age 79, there's $152,000, almost $153,000 in cash value. Death benefit, $315,000. And here we have, if it was the non-guaranteed, $1 million, right? So guaranteed column, let me explain the guaranteed column. The guaranteed column is 0%. Why is it 0%? Because there's no guarantees in the stock market, okay? Now, for you to get this guaranteed column, for this guaranteed column to actually happen for you, that means the stock market would have to, in this example, what we're looking at, the stock market would have to perform negatively every single year for 50 years straight. Think about that. Think about the odds of that happening. The stock market performed negative every year for 50 years straight. That's the only way you'll get a negative interest rate credited towards your account, right? And even so, we looked at it, and, the policy is still running. Is it realistic to think that you'll get a negative interest rate credit or negative numbers based on the market for 50 years straight? That's beyond unrealistic, right? That I don't think, if that did happen, we have bigger things to worry about then. We won't even care about money. If the market was, we're talking Amazon, Google, Walmart, Costco, all these companies going belly up for 50 years straight. That's how extreme it has to be for it to be a 0% rate of return for 50 years. So the column is right there, right? But if you talk to anyone, I'm asking you guys, do you think it's realistic for the market to be negative for 50 years straight, right? And if it did, would you even care about this account? Would you care? You wouldn't care. We probably wouldn't be using money, right? We're trying to figure out what are we going to eat tomorrow type of thing, right? But that's neither here nor there. But that's the guarantee column. So the guarantee column means the market was negative, so you got the 0. So they're only guaranteeing you what the market can do. So if someone says, look at the guaranteed column, then that means they have no faith in the stock market. But I'm sure that same person that says, look at the guaranteed column is telling you, hey, you need to invest your money directly in the stock market, because if you think the stock market is going to boom, right, then why would you think the IUL that's following the stock market is going to perform at 0? That makes no sense. Yeah, I think the market's going to do a 12% average over the next 50 years, but the IUL that's following the stock market is going to perform at 0% over the next 50 years. such a contradiction. It makes absolutely no sense, but I'm here to cover it. I'm here to cover it, so I want you guys to see it. So that's pretty much the answer to that question, right? So that's your guaranteed column at 0%, and it's still performing. It's still in force, and we're talking 50 years out, okay? And then the last one was over 30 years, the average basic Roth beats an IUL in wealth creation 33 times to 1, okay? So first off, I'm assuming we're talking about a Roth IRA here, right? So a Roth IRA is a tax shelter. It's a retirement account. So there's no investment. A Roth IRA is not an investment. A Roth IRA must hold an investment. It tells you how that investment is going to be taxed. Okay, so if you're in the financial industry, you should know that, right? So because the Roth IRA can hold mutual funds, it can hold stocks, it can hold commodities, it can hold real estate, it can hold a cash account. Because think about it, let's say you had a Roth IRA and you're invested in stable funds at 0%. There's no that's not going to be the IUL. At 0% is not going to be an IUL. Let's say your Roth IRA is invested in bonds. Probably not going to be an IUL. So it's all about what you're investing in. But if you're investing in S&P 500, I get it. Then you're side by side comparing. But again, the IUL was not meant to try to beat the market. The IUL was meant to give you upside potential with downside protection. You want your money to grow, but if the market were to go down, you want that protection against loss. That's the point of the IUL, in addition to the tax benefits that come along with it as well. And the early access, you don't have to wait till you're 59 and a half years old like you would with a Roth, right? So that's why people put money inside IULs. So that makes absolutely no sense, because it makes me seem like you don't really understand what a Roth IRA is, because a Roth is a tax shelter. It's not an investment. Investments are inside of a Roth, and it could be any type of investment inside of a Roth. It could be real estate inside of a Roth. So that didn't make sense, but 33 times to 1, that's pretty high. So pretty much what you're saying is, let's take a look at this. So here we are at year 30. So year 30, $500 a month, all fees deducted, and we're at $347,000 in cash value, assuming a 5% rate of return. So I want to see what that compares, because it should be 33 times that. So you should have 33 times that. So I'm going to run a market performance at 10%. So I'm going to double the interest. I'm going to assume there's no fees at all. So I'm going to put the whole $6,000 in there. We're going to pretend like there's no fees, and we're going to double the interest, and I'm going to see if we can get 33 times the amount of money. So I'm going to record my screen over here on my iPad while I do this calculation, because I need a compound interest calculator. Okay, so here we go. Compound interest calculator. So principal amount, we're going to start off with $0. Monthly deposit, we're going to put the entire $500 in. Period, it's going to be 360 months. And we're going to do a 10% rate of return. And again, we're going to assume no fees at all. We're going to double the interest rate, and we're going to assume no fees, and it's going to compound annually. Let's see what we end up with. We end up with a maturity value of $1 million, $39,646. And that is not 33 times $347,000. It's about 3 times that. So let's see. Let's do that. 347, 682 times 3. So it's a little less than 3 times. So you said 33 times. It's less than 3 times. So let's just round up, and let's say it's 3 times. And that's assuming the market did 10% and there's no fees being deducted from this account at all. And we're going to assume no taxes at all either. But let's say if we did a 5%, if we did 5 and 5. So 5%, calculate that, it'd be $409,000. So that's pretty close, right? So it's $409,000. But when you factor in that the IUL, you're able to access that money tax-free, I don't know. I think you'd be winning in the IUL, and that's even with paying for a death benefit and all whatever fees being deducted. That's pretty surprising to me that is that close, right? That is surprising. But, let's say if the market did 15%, 2.8 million, still not 33 times the rate. So we can say that that was completely false, that a Roth is going to give you 33 times the interest that you'll get in an IUL. I thought it was going to be more than 3 times, but it's about 3 times. And again, that's assuming no fees. And realistically, we know there's no account that has no fees. And we're assuming that it's going to do a 10% rate of return compared to the IUL only doing 5% rate of return. So if we did an IUL, if we did a 10% rate of return on the S&P, I would say the IUL can do 7 and some change. So if we did 7 and some change, easily you'd probably be closer to $500,000. So it'd be even smaller. It'd be like two times and some change, 2.5 times the amount. So I hope that makes sense. So I think we covered all of the areas. We did. So we covered all 8. So I responded to all 8. And this video is probably way longer than I thought it was going to be. But again, I put the timestamps in there so you can navigate through this. Thank you guys. If you made it to the end, put a thumbs up. If you got some value, put anything in the comment section because it helps YouTube. YouTube doesn't push videos out unless there's comments and likes and things like that. And I think this information needs to get out to other people because, you know, you guys will let me know how big of a company Primerica is, and hopefully they're teaching the right message. And hopefully this was just, you know, one apple in a bunch of great shiny apples that Primerica has. I don't know. You guys will let me know in the comment section. So if you're looking for a simple, easy to understand explanation of what an IUL is and how it works, you're in the right place. And don't get me wrong, I do believe it's important for you to understand the product and how it works and all the details. But I think all of that's irrelevant if you don't have a foundation of at least understanding of what the product is, how it works, and what you should be looking for on the positive side and on the negative side. So for starters, IUL stands for Indexed Universal Life. All it is a form of life insurance. So what life insurance does is you pay an insurance company a premium every month, quarterly, annually, semi-annually, whatever. And they agree that if you were to die, they're going to pay your beneficiary a tax-free death benefit. Simple as that. You make your premium, you die, they're going to pay your beneficiary a sum of money. Now, when it comes to life insurance in general, it's separated into 2 different categories. On one side, you have term insurance. So term insurance is a policy that's going to last 10 years, 20 years, or even 30 years. That's it. Now, the great thing about term insurance is that it's cheap and affordable because it is only temporary insurance, which means if you get a 20-year policy and you live past 20 years, the policy is over. So there's no refund. In most situations, there's no refund unless you're paying for a refund. But in most situations, there is no refund. It just is what it is. You go your way. The insurance company goes their way. I mean, obviously, you can renew, which just means you're getting a brand new policy. So it's not like you're renewing the same policy. You're just starting from scratch all over again. And there's actually like a high 90% chance that you outlive that term, which is still good because that means essentially you're still alive because ultimately you want to be alive. But from a numbers perspective or a financial perspective, you'll pay into that policy and there'll be no benefit on the back end. So that's in a nutshell term insurance. And again, people get it because it's affordable. You can get a large death benefit and it's not going to be as expensive as the second type. So the second type of insurance is what's called permanent. So permanent goes to age 121. That's what they consider permanent. And most policies go to age either 100, but most go to age 121 nowadays. But that's what they consider permanent. So with a permanent policy, it's a little different. So it is going to be more expensive because it's lasting to age 121, and more than likely, you're not going to outlive the policy. So what that means is the insurance company know they're going to have to pay out a claim one day. So that has to be factored into the price, okay? Now, with permanent insurance, there's also a component to it called cash value. And I'll explain how cash value works. That may have been the reason that you clicked on this video to learn how this cash value works. Now, before we get to the cash value, I want to cover an important part, and that's the cost of the policy. Because policies are not free, you do have to pay for them. So there is going to be a general cost to keep that policy in force, right? Now, inside that cost is going to be subdivisions of different costs, right? So I tell people it's kind of like if you go to a mechanic and you get your car repaired and the mechanic says, hey, it's going to be $300. That's the most important thing to know. How much am I coming out of pocket to pay for your services? And that's going to be $300. Now, the second question is, how is that $300 allocated? They say, okay, it's $100 for your brakes, $100 for your transmission, and I don't know, $100 to get you some new tires or whatever it may be. So same thing with life insurance. On the cash value side, it's going to be cash. Now on the fee side, you want to know what the big number is, what's the total cost to the policy, and then secondary, you want to find out exactly where those costs are coming from. You may care, you may not care. Some people just want to know like, well, I'm putting in this, how much is going to fees, right? Teach his own, right? But those are the two ways you want to look at it. Same way you going to a mechanic, you want to know the total cost and then the breakdown of the total cost. So in this example, let's say you got an insurance policy and the total cost was $100 a month, right? So $100 is going directly to the insurance company to cover whatever excess fees, accumulation of cost of insurance, and whatever else. Now, when you make your premium payment, so that's just like your monthly payment, your premium payment, let's say your premium payment is $300. So you're going to pay $300 to the policy. The first thing the insurance company does when they receive that $300 is they're going to deduct the cost of the policy. So remember, the cost in this example was $100. So they're going to receive $300. They're going to deduct $100 for their fees. So mathematically, that means there's $200 left over, okay? Now that $200 is what goes to your cash value, okay? And that cash value is what grows and earns compound interest and does all those amazing things. But it's important to understand how that structure works. You're gonna make a payment, and of that payment, there's gonna be a deduction of cost, a deduction of fees. Everything above the fee goes inside your cash value. So when you're structuring these policies, sometimes you may run across a policy that's set up where the cost is $100, so you're only putting in $150. Now that means only $50 is going towards the cash value, given those numbers don't change. Let's just assume those numbers don't change. Now, if you put in more, that means more money is going to your cash value. So ideally, if your focus is death benefit, then you want the largest death benefit and you want that premium payment to be as low as possible. Now, if your focus is cash value, then you want that death benefit to be low because the death benefit is associated with the cost. So you want the death benefit to be low and you want to put in as much money as you can. So it's kind of different than how you normally get life insurance, because normally you say, hey, I want $500,000 in coverage, and the agent's going to say, okay, great, that's going to be $200 a month. This is the opposite. You're going to say, how much can I put in a month? And based on that monthly amount, then your agent will do the back engineering to figure out what's the smallest, most efficient cost of insurance to get you so that we can maximize every dollar you're putting into that policy. So let's say the cost is still $100, but you decide to put in $500. Now what that means is now $400 is going to your cash value, and that's what's going to grow and earn compound interest over time. And that number's flexible. You're not locked into whatever you choose. If you start off with 200 and you raise it to 3, then raise it to 5, you can raise it back to, not raise it, you can lower it back to 2, and so on and so forth. So it is flexible when it comes to the premium. But that's the structure of it. You have a fee and you have a cash value. You're going to put in your money. The fee is coming out first on top, and then whatever's left over goes to your cash value. So if you're focused on cash value, you want to put in as much money as humanly possible so that you can maximize the cash value to its fullest potential. So now you have a general understanding of the fee structure and the overfunding of the cash value. Next, we want to talk about how does that cash value move? What is it actually invested in? So your cash value is going to be following an index. So I'm just going to use one index because it's almost in every policy you run across, and that's the S&P 500. So the S&P 500 is just an accumulation of the top 500 U.S. stocks, the U.S. companies, right? So collectively, you put, you got the Apple, Google, Walmart, Costco, all of them, all 500. Collectively, what they do is the S&P 500. Now, what this index does, your cash value is not invested in the market, but is following the market. It's tied to the market. All that means is that if the market were to go up, the index that you're actually in will mirror that, and you will get that amount credited to your cash value. So if the market went up 5%, then you should expect a 5% credit towards your cash value that particular year. Now, there is a cap. So there's a cap to how much you can get in a policy. Depends on the company. You'll see 9, 10, 11, 12, all the way up to 15, sometimes higher. So let's just use 10, even number. So let's say 10% is the cap. So if the S&P 500 does 5%, you'll get the 5% credit towards your index. S&P does 8%, you'll get the 8% credit towards your index. S&P does 10%, you'll get the 10% credit towards your index. If the S&P does 15%, this is important, the S&P does 15%, you're going to get 10% credit towards your index. The cap of this particular example is 10%, so you can't get more than 10% credited towards your cash value because that's the cap. Now, on the flip side, there's also a floor, meaning the S&P, even though it is the top 500 companies, they don't always move up. Sometimes it goes down. So if the market were to drop, you have what's called a floor. Floor is like the worst case scenario when it comes to the credit. And the floor is 0. In most situations, 0%. So that means if the S&P went negative 10, you're going to get 0, meaning you'll stay exactly where you left off. You're not going to lose any of your gains. So all your gains are locked in as far as performance. So it's locked in. But if the market were to perform negatively, then you're not going to get that negative credit towards your, or negative deduction towards your cash value. It's going to stay exactly where it is. So if you're going to visualize how the actual money is going to be moving, it's going to be like a staircase. It's going to go up when the market goes up. It's going to flatline when the market is down. It's going to go up when the market's up. It's going to flatline when the market is down. So remember, you're going to have that cap is the best case scenario, and you have the floor, which is the worst case scenario. So that's a general understanding of how the market works or how the index works, because your money's not in the market, but it's tied to the market, tied to the performance of the market, and that's where your index credits come from. Next, we want to talk about accessing money. So there's 2 ways to take money out of a policy. One is a withdrawal, and that's pretty straightforward. You're just withdrawing your money out. In most situations, people don't use the withdrawal method. Most people are taking policy loans, because with policy loans, you're able to access the money and all the growth and accumulation, and you don't have to pay tax on it because there's no tax on loans. So when you want money, let's say you have, $10,000 built up that you have access to inside your cash value, and you want it $5,000. All you're going to do is reach out to the insurance company and request a loan for $5,000. An insurance company is going to give you a loan for that amount using your cash value as collateral. So they're not going to take money out of your cash value. They're going to give you a loan directly from themselves, the company, but they know your cash value is collateral. Similar to like if you were to take money out of your house, technically there's no money in your house, but your house has a value to it. So if you were to take a line of credit, the bank's going to give you the money because they know your value is worth it. If you don't pay back the loan, if you default on the loan, then they can come claim the money from your house. Same thing with the insurance company. They're going to give you the loan because they're looking at the balance sheet and they can see you clearly have enough money to cover that loan. In worst case scenario, you didn't pay it back. Which brings me to the next point. Now, when you take that loan out, the insurance company is going to charge you an interest rate. It could be, it could be 2%, it could be 4%, it could be 5%. But you want to check with that company before you take the loan out. And at the same time, you're also going to be getting an interest credit. Because remember, you technically didn't take your money out of the cash value. So that money's still parked inside your policy, earning whatever interest is. Whether it's a fixed rate, whether it's not fixed rate, just know that you're going to be charged interest from the insurance company, but you're still going to be earning your interest credit inside your cash value because you technically didn't take your money out of the cash value. And then lastly, what happens when you die? So let's say you borrow money against your insurance policy and you died with an outstanding loan. So in that example I gave you, you had $10,000 of cash value. You borrowed $5,000, okay? Now, let's say you were to die at that point. What happens is the insurance company is going to take that $10,000, pay themselves back, repay the loan back, and then whatever's left over is going to be added to your death benefit, and that's going to pay out to your beneficiary income tax free. Okay, so remember, you have your cash value, and there's also a death benefit. So let's say your death benefit was $100,000. So what it would look like is you have $100,000 in death benefit, you have $10,000 in cash value, but you have a loan that you've taken out for $5,000. So they're going to take $5,000 of that $10,000, pay themselves back, and that remaining $5,000 gets added to your death benefit. So that $105,000 in total death benefit will now pay out to your beneficiary income tax free. Okay. So those are the main components you want to know, at least have an understanding when you're looking into maybe getting an IUL, or maybe you have one, you want to understand it better. And trust me, there are more advanced videos. I actually have some more advanced videos you could check out. But this is a good foundational video you can use as a stepping stone as you increase your knowledge over the IUL subject. Why in the world would somebody use life insurance to buy real estate? I mean, how does that really work and what does that actually mean? So if any of those thoughts have ever ran through your head, you're in the right place. I'm gonna do a simple breakdown of how to use life insurance to buy real estate, and I broke it down to 6 simple steps. Step 1 is to decide what type of life insurance you actually want to use. And the reason so many people are turning to life insurance is because people don't trust banks the way they used to. And that's twofold, because people don't trust the business operations of a bank, and people are not trusting the financial strength of a bank either now. So because of that, life insurance is looking like a much safer option when it comes to parking your money. You see, banks operate on what's called fractional reserve banking. So that just governs the amount of money they have to keep on reserve based on the deposit. Because legally, when you deposit money in a bank, there's a certain portion they have to keep in reserves, and the rest of it they can give out in loans. And what a lot of people are not aware of is that in 2020, they lowered the reserve requirements from 10% to 0%. Meaning now you put in $1,000, they could take that entire $1,000 and loan it out to someone else. So literally they don't have to keep anything in reserves anymore. And that's just one reason why people are looking for alternatives to the normal banking system. Now, the 2 most common types of life insurance policies used for buying real estate are whole life and index universal life, also referred to as IUL. And both of these are considered permanent policies that grow cash value. And I'm not going to go into too much depth on the details of the 2 different policies, but I will go over one of the main differences between the 2. And that's the way the cash value grows. See, with a whole life policy, you're going to get a fixed rate of return somewhere around 5 to 6% annually. So you're not going to see fluctuating interest rates. Now, when it comes to the IUL, the growth of the IUL is going to be dependent on the performance of the market. So if the market performs well, your cash value is going to grow following it up until a cap. The cap's the most you can get on an annual basis. Usually that cap is somewhere around 8 to 12%. And then there's a floor. The floor is usually 0%. That means if the market were to decline, you're guaranteed you'll never lose money because you can never go below that 0%. So that's just a quick snapshot on how the different cash values work from policy to policy. If you want more details, I'll link specific videos at the end of this video so you can take a deep dive and learn more about each product if you like. Now, step 2 of the process is actually setting up your policy. And I tell people all the time, the most important part of this is having a strong and ethical agent that knows what they're doing. Because when you have a strong and ethical agent, they'll be able to take care of everything else when it comes to setting up your policy the right way. So the first thing to do is to work with a strong life insurance company. And that's pretty easy to do because most life insurance companies are strong. You may find some with slightly higher ratings here and there, but for the most part, they have good financial backing. And again, having a strong agent will make sure that you're working with a strong, reputable insurance company. Now, after that, you want to make sure that the products you're being offered has the right loan provisions that match your time horizon. Because there are companies that offer loans starting at 30 days, and there's also companies that offer loans starting at month 13. So make sure to assess your goals and make sure whatever your time horizon is for your goal matches when the loans will be available to you. So now you got that out the way, now you move on to the policy structure. So life insurance policies can be structured 2 different ways. There could be a death benefit focus and there could be a cash value focus. For the scenario of buying real estate, in most situations, it's going to be a cash value focus. And I always teach people to look at the death benefit and the cash value as like a seesaw. If the cash value is high, that means your death benefit is going to be low. And if your death benefit is high, typically your cash value is going to be low. And the reason you want your death benefit to be low and your cash value to be high is because when you put money into the policy, you want the vast majority of the money that you put in to go towards the cash value versus being eaten up in cost, because the death benefit is something that you have to pay for. So you want that cost to be as low as possible so you can get as much money to your cash value as possible. Because again, the cash value is what's going to be leveraged when it comes to getting a policy loan. So you want that cash value to be as high as possible. Now, step 3 is funding the policy. This is the process of actually taking money out of your bank account and putting it into the life insurance policy. So once you have your policy structured the way you want it and it's time to fund the policy, you want to know what your flexibility options are with your payments. Because when funding your policy, there may be times where you want to put in more annually and there may be times where you want to put in less annually. So it's important to know what are those parameters, what's the most you can put in and what's the least you can put in. Now that minimum amount, that's what's going to keep the life insurance policy in force, because again, it is life insurance, so somebody has to pay for the death benefit. So you want to know what's the worst case scenario, what's the lowest you can put in. Now the max amount, that's the most you can put in without creating a MEC, a modified endowment contract. And creating a MEC just means you violate the IRS guidelines as far as how much you can put into the policy. And if that happens, you pretty much lose all the tax benefits of the policy. And I wouldn't say this is something to stress over, because if you accidentally paid too much to your policy, most carriers would just send you a check back because they know you don't want to mech your policy. Now, the most common way I see people pay into a policy that's using it for real estate investing is they'll start off with a larger lump sum, and then every year after that will be a smaller amount. And that's called front loading your policy. And the reason for that is because they want that cash value to be high really fast because they want to immediately take money out of it to use it for, obviously, real estate investing. Now, if you don't have a lump sum to front load your policy, you can still do it on a monthly, quarterly, semi-annual, or annual basis. But with both funding options, you'll still be able to leverage that cash value when it comes to getting a policy loan. And that moves us into step 4, which is actually taking a policy loan. And this is another huge benefit that really attracts real estate investors. And the reason you want to take the money out in the form of a loan and not a withdrawal is because if you withdraw the money, everything above your cost basis is taxable. But if you take a policy loan, then you avoid taxes altogether. And the process of getting a loan is fairly simple. You'll complete a 2-page document, ask for your name, your policy number, how much you want. You have to sign it, date it, send it back in. And from that point, it'll take probably maybe 5 to 7 business days to get your money. If it's a company that does direct transfers, they'll transfer it right to you, but it's not a big deal at all. And depending on the type of life insurance policy you have will determine which loans are available to you. With whole life, it's gonna be more of a standard fixed loan, and the average loan charge for that is gonna be somewhere around 4 to 5%. Now, one important thing to understand is that when you get a policy loan, that money's not coming out of your cash value. That loan is coming directly from the insurance company. That means your cash value stays parked exactly where it's at, earning uninterrupted compound interest. So if you have $100,000 in cash value, but you've leveraged $90,000 for a loan, that entire $100,000 stays parked, earning interest nonstop. So it's giving you an opportunity to earn interest on the same dollar in 2 different places because the money's still in the cash value, but at the same time, you have the money in hand and you're putting it somewhere else, earning interest on another investment too. And that's why real estate investors love these policies so much. Now, when it comes to the IUL, they have the same type of loan that the whole life has, but they have an additional loan where you can earn whatever the market is earning. So let's say you have an IUL and you take a loan out and the loan charge is 4%. Now with the IUL, it's growing following the market. So let's say the market does 7. So you're being charged 4, but you earn 7. So you have an opportunity to create a spread of 3%. There's not many places where you can take a loan out and get a spread on your money. Of course, this option comes with more risk because the market's unpredictable. So if the market does 2, then you're upside down on your loan for that year. The good thing is that you can switch back and forth every policy year to different type of loans. So if you're in a loan that follows the market and you want to switch it to a fixed rate of return loan, you could do that every anniversary of the loan. And as far as paying back the loan, that's completely up to you if you pay it back or not, or how you pay it back. But I always tell people, if you're trying to treat this like your own bank, you want to treat your own bank with the same respect that you treat an institutional bank with, and pay back your loan. Now, in the event you actually die with an outstanding loan, this is what's going to happen. Your cash value that was leveraged for your loan, that cash value will pay back your loan, and whatever's left over will be added to your death benefit and pay out to your beneficiaries tax-free. The second scenario is whatever's outstanding in the form of a loan gets deducted from your death benefit, and whatever's left over gets paid out to your beneficiary. And obviously you get to choose which option happens when you're setting up your policy. Now, the next part I wanted to cover is not part of the 6 steps, but is really valuable, so I wanted to make sure to include it in part of the video. And this is what's called a collateral assignment loan. Now, this will require you to do some work, but it may be worth it for you. So with a collateral assignment loan, you're gonna have to find a third-party lender that accepts collateral assignment. And what happens is you're gonna get a loan from that lender, and you'll be able to use your death benefit to secure that loan. Because in most situations, you're taking a loan directly from your own personal policy and you're leveraging the cash value. But in this scenario, you're taking a loan from a third-party lender and you're leveraging your death benefit. And the reason this is so significant is because your death benefit is larger than your cash value from day one. So the way it works is you'll get a loan from the lender, and the reason they'll give you the loan is because what you're doing is you're making that bank or that lending institution the actual beneficiary of that amount that they're loaning you. So what that does is secure the loan because the bank knows they're going to get their money back if you were to die because it'll be coming directly from the insurance company in the form of a tax-free death benefit payout. So it's definitely worth looking into. So you'll have to find a lender that accepts collateral assignment, and you have to be working with an insurance carrier that allows collateral assignment because not all of them do. So now that you have cash in hand, the next step is for you to actually go out and buy your property. Now for this step, you would use whatever method you use for buying real estate. So if you do flips, you can 1031 into new properties, or you can just take the money, pay the tax, and then pay back your policy. You can do whatever you want. If you're doing rentals, you can take that rental income profit and start paying back your policy. You can do whatever you want at this point. This is the part that you control. But the goal is to some kind of way make sure you continue to pay back the loans and create your own bank. And the last step is tax-free retirement, because no matter what we're doing, eventually we get to the point where we're like, stick a fork in it, I'm done. So at that point, all this accumulation, all this compounded growth over all these years have built up, and you can now turn that policy into a tax-free retirement income stream. And this is powerful because a lot of entrepreneurs, a lot of self-employed people don't have traditional retirement plans. And if you do have one, in most cases, it is a taxable account. So this is a great addition to add to that, because this money is going to come to you 100% tax-free. And not to mention, you have a permanent death benefit that's going to last to age 121 that will for sure be part of your legacy and pay out to your beneficiary income tax-free. So that's how you use life insurance to buy real estate. So whole life and index universal life are two of the strongest cash value policies that exist. And I'm sure if you're watching this video, you're aware of that. But the question is, which one is better and how do they compare to each other? So instead of making this 3-hour-long video about all the details and how they're different, I want to answer the 2 common questions I get more than anything else. And I've been doing this since 2007, and I can tell you these 2 questions I get asked more than anything else. And that is, 1, how is the policy going to earn interest? How is it going to grow? And 2, how is my cost of insurance calculated? And at the end of this video, I'll link 2 other videos, one to my IUL video, another to my whole life video. And that'll give you more details if that's where you want to go. But otherwise, this is going to cover the 2 most common questions I get when it comes to IUL versus the whole life policies. So when it comes to the cash value in a whole life policy, everything's built around guarantees. So you'll have a guaranteed column, and that's going to guarantee you somewhere between 2 to 4%, depending on the company, but it's going to be 2 to 4% guaranteed. Now, in addition to that guaranteed column, there's also a non-guaranteed column. Now, that non-guaranteed column is including dividends. So what dividends are they're a portion of the profits paid back to the policyholders. So, and not all whole life policies offer dividends, so it must be a participating policy. But if it's a participating policy, it's participating in dividends. So it will receive dividends every single year. So in most whole life companies, they've paid out dividends. The ones that do have paid out dividends for over 100 years. So it's not, even though it's non-guaranteed, it's pretty consistent. So you'll have your non-guaranteed column that's going to be somewhere between 5 to 6%. So it's important to understand that your non-guaranteed of 5 to 6 is not in addition to your guaranteed of 2 to 4. So let's just use 4. Instead of going 2 to 4, let's say it's 4%. And for the dividend, let's just assume it's 6%. So it's not like you're going to get 6% plus 4% net 10%. It doesn't work that way. The guarantee is 4%. The dividend is 6%. So all that means is that it took that 4% and added an additional 2% in dividend to give a total dividend of 6%. So it's the original 4% guaranteed plus the 2% added, which makes a dividend of 6%. So that's how the dividend rate works. So just know the dividend rate is going to be somewhere between 5 to 6%. So when it comes to your cost of insurance is going to be leveled out. So here's what I mean. So let's say a 30-year-old's cost of insurance is here, and by the time they get 90 years old, it's going to be up here. So what whole life does is say, okay, it's going to be here at 30, here at 90. So we're going to do an average and just pay that level throughout the life of the policy. So what that means is, yes, in your early years, you may be overpaying for cost of insurance, but in the later years, you may be underpaying for the cost of insurance. Now, it's important to understand your cost of insurance is not the same as your total premium paid, which is your payment into the policy, because when you're structuring these policies for cash value, you're overfunding the policy anyways. So let's say you're putting in $1,000 a month into the policy, your cost of insurance may be $100, or instead of $100, it may be $60. But just know the difference in that small change from it leveling out and paying over in the early years is not going to change what you're paying into the policy. So what you're paying to the policy is going to stay the same. It's just internally the cost is going to be leveled out. So you'll be overpaying early, underpaying later. And that's how they keep that payment level. So now when it comes to the cash value of the IUL or Index Universal Life, it's a little different because you have 2 different categories. One, you have a guaranteed column. So the guaranteed column is going to give you somewhere between 2 to 4% fixed. So you get 2 to 4% the same way you get in the guaranteed column of the whole life policy. So that's one. The difference is with whole life, you get your guaranteed and then some. Now with IUL, you don't get the guaranteed and then some. You have to choose the guaranteed and you're going to get the guaranteed only. So guaranteed can be one option, or you can get the index option. So if you choose the index option, you're not getting any of the guaranteed 2 to 4% at all. So with the index option, it still has a guarantee, but the guarantee is typically going to be 0%. So here's what I mean. They operate with a floor and a cap. The floor is going to be more of what's considered your worst case scenario, and the cap is going to be your best case scenario. So let's say this index has a floor of 0% and a cap of 10%. Here's what that means. That strategy is going to follow an index in the stock market. So let's say the S&P 500. So it's going to look at the S&P 500 and it's going to follow the S&P 500 with a floor and a cap. So that means if the S&P 500 does 5%, then you get 5% credit. It does 10%, you get 10% credit. If it does 15%, you still only get 10% credit because 10% was the cap. That's what you have to understand. Nothing above that is going to be credited towards your account because you have a cap of 10%. Very important to understand. Now on the flip side, you have the floor. Floor means if the S&P 500 did negative 20, so you'll never get a negative deduction based on the poor performance of the market. So in that situation where the market did negative 20, you'll get 0. So you're not gaining anything, but you're not losing anything either. So you'll always be between that 0 to 10% based on the performance of the market. Now with the IUL, there are more risk involved because it's following the market. Because if the market goes negative for the next 20, 30 years, you won't get any interest credits towards your cash value. So it's very important to understand that when you deal with IUL, there's more risk involved because it's flexible. Things can move. It's not guaranteed like whole life is because we don't know what the market's going to do. It could do 4, it could do 8. But if you believe the market's going to perform better than what the rates you can get in a whole life, then IUL may be a better fit for you. But if you feel like you like the guarantees of the whole life, then the whole life might be a better fit for you. So whole life is definitely going to be less risky than IUL because IUL follows the market and the market is not guaranteed, but at the same time you have potential to get higher rates of return based on the performance of that same market. So that's the index and how it works. So you can have a 10% cap, 0% floor. Following the market, you get the credit whatever the market does, whether it be 10, 8, 7, 4, 0. If there's a negative year, you're not going below 0. So that's the growth. Now on the cost of insurance side, IUL uses what's called an annual renewable term. From the example I gave, the 30-year-old, the cost is down here, but when they turn 90, it's going to be up here. So what IUL does is charge you based on the age you are. So it's going to be cheaper up front and more expensive as you get older. Now the downside from that would be, okay, I have to understand that it's going to be more expensive as I get older. But remember, you're overfunding the policy, so it's not like it's going to change your payment. So if their payment was $1,000 a month, it's not going to affect that $1,000 a month. That will still be your payment. Now the benefit is the cost of insurance is based on my current age, so it's going to be as cheap as possible. So the cost will be lower earlier, giving me more chance to accumulate cash value earlier. And as I get older, that cash value should have accumulated so it can help pay for the cost of insurance. So in both situations, your cash value is going to pay for the cost of insurance through accumulation. Just one levels it out. One says you're going to pay whatever your age is now, which is lower earlier and more later. So based on the cost, it depends on what floats your boat. Now with the IUL, it is flexible, so there's some things you can do on the back end because as the cost of insurance goes up over time, you can change your death benefit option, which can reduce the net amount of risk, which reduce the cost of the policy. That's just standard how it works. One's level, one's increasing, but you can adjust it to make it fit your needs. So I always say work with a strong agent that can show you the details if you are interested in IUL, but you want to see how that cost affects you in the later years, or if you're interested in a whole life policy and you want to make sure that that level of death benefit is not overinflated in the early years. If you need help with either strategy, there's a link in the description box. Click that, set up a consultation, and we'll help you figure out what's the best for you based on your goals, not what someone else wants to do, what you want to do based on your goals. So today we're talking about IULs, but mainly about how your cash value is going to grow. Because if you heard of IUL, you may know the basics. Okay, there's a floor, there's a cap, guarantee against loss. But as you take a deep dive and actually look into the policy, you'll see that there's various different account options you could put your money in, but nobody explains that. So I wanted to create this video because if all those options are available to you, I want you to understand what they are, how they work, pros and cons, so you know exactly how to allocate your money. Because you'll probably be working with an advisor, and yes, you may trust your advisor, but I really think it's important for you as a consumer to still have some information as far as how these allocations actually work, so you could do what's best for you, not what's best for your agent. So if you looked into an illustration or maybe your current policy, I'm sure you've seen there's different definitions for how your money can grow. So I'm going to break those down so there's complete transparency. So the most common option you run across is the cap and the floor, right? So the cap and the floor is an actual strategy. So typically, let's just use, for example, 10% is the cap, 0% is the floor. So here's how that works. So on the result side, your growth or your credits is determined by the strategy that you choose. So let's say the market went up 6%. Now that means you're going to get a 6% credit because remember, you're within that range of 10 to 0% at all times. So if the market did 6, you get a 6% credit, pretty straightforward. Now, if the market did 10, you get a 10% credit. Now, here's what you have to understand. If the market does 15, you can't go above that cap. The cap is 10%, so you'll get a 10% credit. You will not get a 15% credit. Only a 10% credit if the cap is 10. Now, when it comes to the floor, if the market does 0, you'll get a 0% credit, meaning you'll get no growth towards your account at all that particular year. Now, if the market did negative 10, that's where the floor really becomes the hero. You get 0% credit. You don't lose, you don't gain, you stay exactly where you left off. Same thing if the market did negative 40. So it doesn't matter how bad the market gets, you're always protected from negative deductions because of the negative performance of the market. Another important note is that all previous gains are protected from negative market losses. So it doesn't matter how bad the market is, you're not going to get a negative deduction because of the market performance. So if you start off with $1,000 and it grew to $3,000 and the market were to crash, $3,000 is now your floor. Does it go back down to $1,000? $3,000 becomes your floor. And as the market drops, you'll stay there. And if the market rebounds, it goes up, you'll start at the $3,000 and compound from there. So the cap and the floor is going to be the most common strategy you run across when it comes to dealing with the IUL. Next, we have participation rate. This is where it gets tricky, but I'm going to break it down so you know exactly what to expect and exactly how these accounts work. So in this strategy, you'll see something like uncapped 200% participation with a 0% floor, right? I know that's a mouthful, but it's uncapped, meaning there's no cap to how much you can grow, right? No limit. So the other one had a cap. There's no cap. You get 200% participation, meaning it's going to take whatever the market does and multiply it times 200%, which is pretty much multiplying it by 2 or doubling it. And there's a 0% floor, which means if the market were to crash, you're still protected against loss. So now when it comes to results, here's what we're looking at. So if the market does 6% growth and you have a 200% participation rate, they're going to take that 6% and multiply it by 200%, which is multiplying it by 2 or doubling it. So you'll actually get a 12% credit towards your account, right? The market grew at 6, you get 200% of that number, which means you get a 12% growth towards your account. So if the market did 10%, you'll get a 20% credit towards your account. If the market did 15%, you get a 30% credit towards your account. So remember, it's uncapped, so there's no cap. So we can go as high as it can go based on the performance of the market and the multiple of that 200%. Now on the downside, if the market were 0, you'll get 0. Market goes negative 10, you get 0. Market goes negative 40, you get 0. So that floor of 0% is still there to protect you from negative market deductions. Now, it's also important to understand that not all strategies when it comes to participation rates are a multiple of the strategy. It can be less. So in this example, I'm going to show you a 50% participation rate of the market. So here, if the market does 6, you actually get a 3% rate. So you get 50% of what the market did, or so you get half of what the market did. So if it did 6%, you get a 3% credit. If the market did 10, you get a 5% credit. If the market did 15, you get a 7.5% credit. So that is a 50% participation rate. So if you get a participation rate, you want to make sure you look at, well, what's the percent? Is it 105%? Is it 225%? Is it 40%? Know your participation rate, and then you'll know what you'll earn based on the strategy. And again, the floors are still there, 0 to 0, negative 10, you're still protected at 0. And if the market did negative 40, you're still protected at 0. So these are the participation rates and how those are calculated. So you'll run across those as well inside the IUL strategies. Now, the next strategy is the one you'll probably see the least when it comes to IULs. A lot of IUL carriers don't even offer this strategy, but this one is actually a spread. So here's what a spread is. So with this strategy, it's uncapped, meaning it could grow as large as it can grow, but there's a 7% spread. So the 7% spread means that's the amount of money the insurance company is going to take off the top. So whatever the market grows to, they're going to take 7% and withhold it or keep it, and then you can have everything beyond that. So they'll take the 7 and you can have anything beyond that 7 with no cap. So here's what that looks like when it comes to the results. So if the market does 10, you actually earn 3%. Because remember, the market did 10, they're going to take that 7. That 7 is their spread, and you can have anything beyond that spread. And beyond the spread is 3%. So if the market does 10, you actually only earn a 3% credit towards your account. So if the market does 15, you get an 8% credit. And if the market does 30, you get a 23% credit. So this is a spread. So this is for someone that wants a strategy that's uncapped, but they believe the market's going to grow so high, they're willing to forego that 7% so they can have everything that happens beyond that. So when it comes to the floor, right, same thing. The floor is also there as well. If the market does 7, you get 0. So that's important to understand. They're taking the first 7%. So if the market grows at 7%, you'll get 0. So if you have all your money in an uncapped strategy and the market grew at 7% every year for the next 20 years, you have to understand you'll get a 0% growth rate over those 20 years because you'll never get any growth because they're keeping the first 7%, right? So if the market does negative 10, you're at 0% floor still. If the market does negative 40, you're still at a 0% floor. But that's how spread works. So you have the cap and the floor, you have the participation rate, and then you have the spread. So those are the 3 ways you'll see interest credits towards your account when it comes to the IUL. So now you have an idea of how it works and how your money is going to be credited. So the last thing I'm going to cover is what I call important information. So these are just some points I really think is important for you to understand and know about when it comes to approaching these index strategies. Okay, so the first is rates can change. So if you're looking to get into an IUL, or you have an IUL, it's very important to understand rates can change. So if you're looking at an illustration or a rate chart, make sure it's current. Make sure it's not from 5 years ago or 3 years ago, because rates follow interest rates. They follow market performance, volatility, all these things factor in. So you may be looking at an outdated rate because rates can go up, they could go down. So you want to make sure you're always looking at the most current rates when you're either approaching a product or looking at a product you have currently, so you know what credits to expect in your product. So just understand rates can change based on volatility, based on interest rates. Sometimes they go up, sometimes they go down. So I really believe it's important for you to understand that so you know you're looking at current rates at all times. The next thing is that strategies can be blended. So I showed you 3 main strategies: the cap and the floor, participation rate, and then the spread. They can be blended. So it can say something like, you'll get a 105% participation rate up until a 12% cap. So you just have to do the math on the first part and then do the math on the second part. So if the 105% participation rate takes you to 15%, that's great. But if it says the cap is 12, then you have to understand you're only going to get 12. So they do blend the strategies sometimes. It's not that common, but you'll run across it. So just know, don't be thrown off. You'll use those 3 tools I taught you, and you'll be able to do the math to figure out exactly what you're going to earn. But one thing you have to understand is the cap rules all. So you can have all these participation rates, but if there's a cap, you have to understand you'll never get above that cap, regardless of what the participation rate is. Next thing is understand that allocations can be spread out. So you don't have to put all your eggs in one basket. Even though in all situations you're protected from loss. So you can say, I want 30% in this allocation, 20% here, 50% there. So you can spread it out however you like. So it's not like all or nothing. You can say, I just want 10% in all 10 of these strategies. So no matter what happens in the market, I know I get some type of growth or some type of participation. Because at the end of the day, they're all going to grow. And there's a crystal ball that could tell you which market is going to perform best or which strategy is going to perform the best. So spreading your money out can be a great way to diversify inside of your IUL. And then you have to understand that allocations can be changed. Don't feel like you're making the end-all, be-all decision. You can have an allocation, and then you say, you know what, I want the allocation. I want to change it up. You can do that online. You can call the company directly. It's not a big deal. So you have options where you can change your allocations based on whatever you feel the market's going to do, or based on whatever you learned from the research, or maybe based on what you learned in this video, right? So you can change your allocations whenever you like. And then the last thing you want to understand is there's a difference between real performance and back-tested performance, right? So what real performance means is it's looking at that actual market and telling you what it actually did over that period of time. So if it's something following the S&P 500, it'll look at, hey, this is the actual performance of the S&P 500 over the last 10 years. So you can gauge that to say, like, this is what I expect it to do over the next 10 years. So those are actual performance. Those are real strategies that actually were in real life. Okay, so that's the real performance. On the other hand, you have what's called back-tested performance. So some people are for it, some people are against it. So with back-tested performance, what they're doing is some really smart people, they're sitting in a room and they're looking at historical events, historical patterns. And they're saying, based on the market for the last 10 years or so, if we would have bought here, sold there, bought this, held that, bought that, we would have got a certain rate of return. So let's make a strategy equivalent to that so that somebody can take advantage of what we just learned moving forward. So some people say it's great because they're looking at past events and, the woulda, coulda, shoulda. We can actually make that a reality by moving forward with that same strategy that they tested based on current market trends over the last 10 years, 15 years, or whatever the time frame they use to back test it, right? So it's kind of like, let's say you have a certain path you drive to where you take a certain freeway to work every day, and you know exactly it's going to take you 30 minutes to get to work. But then someone says, hey, based on these studies, if somebody left your house and drove to work but took a different freeway, you'd get there in 27 minutes instead of 35 minutes. So back testing is like, well, nobody's actually technically driven that route, but they're looking at based on traffic flow and everything. So some people are like, oh, that's a great advantage. It's like a crystal ball. But others say like, hey, you know what? It's never really happened. So I don't care what you tell me, the results would have been nobody actually ran these real numbers in real life because those events are part of the past and they don't like back testing. Now, to each his own, right? So the good thing about back testing is that even though it's back tested, once the fund becomes live, you may look at it and it says, okay, it's been back tested 15 years and it has 2 years of actual performance. And you can compare like, okay, this is what they thought it would do based on past performance. This is what it actually did over the last 2 years. I can use that data to decide if that's something I want to invest in, right? So that's the difference between back testing, meaning it didn't really happen. They're using past data to determine what the market could do moving forward. And real examples are they're using actual accounts that actually exist and follow those accounts so the numbers that it's projecting are numbers that it actually did in the past, right? So I hope that helped the understanding of the 3 different ways your credits are, and that you could go back to your current policy or look at a future illustration and have more confidence moving forward with where you actually allocate your money. So today I'll be reacting to a video titled 4 Reasons Why Cash Value Life Insurance Sucks. So I'm type person, I don't run from the opposition. If somebody has something negative to say, I seek the heat. I'm going straight towards it when most people go against it because I understand there's different opinions, but I want to get to the root of it and see what is their concern and if it's really true or just something that they were misinformed on. So my goal is to make sure you're clear on whatever's going to be said in this video. So let's jump right in and check it out.
4 reasons cash value life insurance sucks. Number 1 is it's so expensive. I have $18 million of life insurance on myself. It costs me about $20K a year. That same amount in whole life would cost me $20,000 a month, not $20,000 a year. No.
Okay, so when it comes to life insurance, there's 2 different categories. There's term insurance and there's permanent insurance. So term insurance is going to last you 10 years, 20 years, 30 years, and that's it. It's pure insurance. So it's no cash value. There's nothing else involved. So historically, there's about 90 to 99% chance you will outlive that term. Meaning if you have a 20-year policy, there's a 99% chance you will outlive that 20 years, which essentially is good. But from a financial perspective, you've paid into that policy for all those years and you get nothing in return. Now, the insurance companies know these numbers, obviously. So when they're looking at it, they say, okay, well, I'm going to insure you for 30 years. There's a high chance that you will outlive this term. So if you outlive this term, the policy's over and we never have to pay out a death claim at all. So we don't have to charge you a lot of money because we know this insurance is only temporary. So because of that, as you make these monthly payments into this term insurance policy, that's pretty much all profit for the insurance carrier. So term insurance is extremely profitable because they're taking all these premium payments in and very unlikely that they have to pay out a death claim ever. So when it comes to life insurance, it's more like renting your insurance. You're only getting it for a temporary period of time. And I'm not saying term is bad at all. It's just that if you're looking at a price perspective, it's apples compared to oranges. Now, when it comes to permanent insurance, those typically go to age 120, 121, in some cases 131 years old, right? So with the insurance company, they're looking at that like this very unlikely that you're going to live beyond 120 years. So they understand they will have to pay out a death claim to your family or your beneficiary one day. So they have to bake that into the cost. Otherwise, they'll end up going bankrupt. So they know they'll pay out a claim. So of course, it's not going to be as inexpensive as it would be if you got a term policy, because the term is temporary, permanent is permanent. Death benefit will pay out. Another thing you have to take in consideration when you're looking at a permanent policy is that when you're making your premium payments, all of that money isn't going for the technical payment. It does have a component called cash value. And cash value is where you can put money in, it grows, earns compound interest. You can do a lot of things with it. But when you're making a payment, let's say I made a payment for, I don't know, $300 a month. That $300 is not paying for the insurance. The vast majority of that $300 is actually going to my cash value that I actually have access to. So that's even more of a reason why I say it's misleading to compare term insurance to permanent insurance when you're looking at cost or premium payments. So term would be more like renting the policy, where permanent is actually owning the policy. And based on your goals, that would determine which one makes the most sense. And in some situations, it's both. So now let's look at reason number 2.
Number 2 is that when you put money in, every dollar you put in for the first 3 to 5 years, they take. Imagine going to a bank and you opened a savings account in there and they said, hey, Mr. and Mrs. Client, we're so glad to have you. But just so you know, we won't plan on seeing you for 3 to 5 years because every dollar you put in here, we're going to take. Would you ever open that account if that's what they told you? Of course you wouldn't.
So what he's saying is that in the first 3 to 5 years of having your policy, all the payments that you put in, the insurance company keeps, and you get nothing going towards your cash value. So I say, let's actually look at a policy and see if that's actually true or not. Okay, here we have a policy illustration. So this person is a 35-year-old female. Death benefit is $101,000. But you can look underneath the blue bar where you see premium outlay. Premium outlay is the annual payment that went into that policy. So we can see $6,000 went into that policy in year 1. Accumulated value, that's going to give you a ballpark of how much money makes it towards your cash value that did not get absorbed in cost. Meaning when you put the $6,000 in, you're paying for that $101,000 of death benefit, so that money is removed, and whatever's left over makes it to your cash value. So you can see in year 1, you're finishing the year with $5,306. Then even on the cash surrender value, that's even $4,961, right? So we can clearly see year 1, the vast majority of your payment automatically went towards your cash value. And the same thing happens for years 2 and 3 and obviously moving forward. So I would say what he said is absolutely false based on us looking at the numbers right now. And these are taken into consideration. The costs have been removed for the insurance, but even after that, you still have vast majority of your money going towards the cash value starting in year 1. So I would say that's pretty straightforward. So now let's look at the next thing he has to say.
Secondly, after you start building up some money, you've got to borrow it out from yourself at interest payable to the insurer. Imagine you walked into a bank, you opened a checking account, and they said, man, we're so glad to have you as a client, but if you ever come back here for $1 of this money, we're going to charge you interest till you pay us back. You'd never open that account, would you? But you just did if you bought a whole life insurance.
Okay, so this is probably one of the biggest misconceptions when it comes to cash value life insurance. Now, when you access money, you have options. You don't have to take out a loan at all. You can take a withdrawal. So life insurance works off FIFO, first in, first out. So you can actually take out your cost basis, 100% tax-free, no harm, no foul. Now, you will have to pay tax on all the gains. So if you start pulling out gains, you will have to pay ordinary income tax, equivalent to if you were taking money out of a 401k plan, right? So, but you can withdraw from your cash value right out the gate. Most policies, it's 30 days or so. Now, the reason most people choose to do the loan option is because when you pull money out as a loan, you actually don't pay any tax on that growth. So, for instance, if you had $100,000 inside of your cash value, and let's say you wanted $70,000, you'd request a loan from the insurance company. The insurance company is the one that's actually giving you the money in the form of a loan. So because they're giving you the money in the form of a loan, you're going to have to pay back the insurance company. They're going to charge you interest rate. Let's say they're going to charge you a 3% interest rate. You're going to pay them back plus 3% on that interest rate. Why is that so significant? Because since the insurance company is the one that gave you the money in the form of a loan, that means your cash value technically was not touched. And why is that so important? That means the entire $100,000 is still parked exactly where it was, earning uninterrupted compound interest. Because people fail to understand that even though the insurance company is charging you a rate, they forget that your compound interest is still there, nonstop growing on the full amount regardless of the loan size. So that's what makes people so attracted to the policies, because they could take the $70,000 out, form of a loan. They could, invest it into whatever. Let's say they're investing into real estate, making a rate of return on that $70,000 and still know that $100,000 still tucked in their cash value, earning uninterrupted compound interest. So it could be at a fixed rate, or it could be following the market. So you can create a spread. You have opportunity to create a spread, because if they're charging you a 3 and let's say you're able to earn 8 from the performance of the market, you actually make a net 5%, right? Obviously that comes with more risk, because if the market performs at 0, you get 0. But if somebody follows the market, they understand the market's up more than it's down historically. So they may be okay with that. And you can switch back and forth between loan types every single policy year. You can say, I want a fixed loan where I'm gonna get a fixed charge and a fixed growth rate that usually are the same, 3% charge, 3% growth rate. Or you can say, I want an alternate loan where I'll take a 4% charge or a 5% charge with the ability to grow following the market with whatever caps or participation rates that apply to the policy. So that's why people choose loans versus withdrawals. Another thing, if you take a withdrawal, you can't throw that money back in. But if you take a policy loan, you just created a hole. So let's say you need to take the money for 3 years. 3 years from now, maybe you've doubled it. You can dump that money back into the policy, no harm, no foul, right? So that's where people have that philosophy of being your own bank and things like that. But that's why people use policy loans over withdrawals. But withdrawals are available to you if you want them. So now let's move into concern number 4.
Number 4, way worse than any of those, is when you die, you get the choice of the insurance or the investment. You pay for both, but you only ever get one.
That's another thing that's absolutely false. So I'm going to bring back that illustration so we can look at it so I can show you the actual numbers. Okay, so here you can see at the top, the death benefit is $101,328. That's the face amount. That's your original death benefit. Now, if you look down at the accumulated value, let's just look at year 1, it's $5,306. But if you go 2 columns to the right where it says death benefit, you can see the death benefit is $106,634. Where did that number come from? That number is a combination of the original death benefit, $101,328, plus the actual accumulated value. So if you look at every single year going down and look all the way to the right, you'll see that it is a combination of that initial death benefit plus whatever cash values in the account at that time. So it's not an either or, you actually can get both. So that was his last objection. So we went through all 4. Hopefully you have clarity and understanding, because I'm sure if he said it, he's not the only one that thinks that way. But now if you, as either the agent or you, the consumer, now have a clear understanding of how the policies work and some of the things that could be said about it, that we're able to clear up in this video. So today we're going over a strategy that I'm really excited about sharing with you. And it's a way to increase your retirement income. Because typically most people have money sitting in a 401k plan. Because a 401k plan is a retirement that's given by your job, whether it be 401k, 403b, IRA, but let's just use 401k to keep it simple. So the way a 401k works is you get your paycheck, the money goes right from your paycheck right into the 401k. It's tax deferred, so no taxes are removed. Then it starts to accumulate over the years, and then once it's time to retire and take the money out, then you pay income tax on that money. Okay, so pretty straightforward. So how does adding life insurance to the mix, to the equation, make a significant difference in your retirement years? So that's what I'm gonna go over today, and I'm gonna share a visual with you so you can see step by step how maybe that may be something you wanna look into if you currently have a 401k plan. Okay, so in this example, we're gonna assume you are a 65-year-old and you saved up $1 million inside of your retirement account, your 401k plan. So now it's time to retire and start taking distributions from that 401k plan. So we're going to take a hypothetical S&P 500 return, right, over a 20-year period of time. So in this example, you're going to take an annual withdrawal of $70,000. So let's say you need to live off of $70,000 a year. So you take $70,000 out. Your $1 million has dropped by $70,000. It's pretty straightforward. And that's the $930,000 here. Now, in this example, you got a negative 14.66 rate of return based on the S&P that year, right? And this is going to show you the power of sequence of returns and how it can make a huge impact on the amount of income you're able to take out in retirement. So your balance now has dropped to $793,000. So you start off with $1 million, you pulled out $70,000, that lowered it to $930,000. You got your return for the year, and now you're at $793,662. Pretty straightforward. Now the next year, because we're going to assume a 1% inflation, right? We already know inflation may be more than 1%. We're going to assume a 1% inflation, so you need to increase your withdrawal by $700. So now that's $793 minus the $7,700. Now your new base is $722,000 some change. Market did 26% negative that year, which dropped your balance down to $531,594, right? So you repeat this cycle. So we're not going to go year by year, but you can see the increases annually based on that 1% inflation. So you're going to have to keep up with the cost of living. So you have to take out more and more every single year. You can see your balance dropping and increasing based on the returns and the withdrawals. And you can see the returns of the market. So the next year, the market was up 37%. So it brought your $531,000 to $631,000. So you will have ups and you will have downs. This is how the market works. So over time, this 20-year period of time from age 65 down to age 85, your new balance at age 85 is $444,000. Okay, so you start off with $1 million. As you start taking withdrawals, you get the gains and the negatives of the market, whatever it may be that particular year. But now, based on this historical return of this S&P 20-year period, your balance would be $444,000. Pretty straightforward. So that's what it looks like for most people in retirement when they start taking money out. And again, past performance is not indicative of future gains. So the S&P is not going to do this exact number over a 20-year period of time, but this is just one example. Okay, so now I want to show you the strategy of what it looks like if you were to incorporate life insurance to the equation and have it work hand in hand with your 401k plan. So as we see, there's you at the 65-year-old. You have that same $1 million balance. You took out $70,000 year one, drop it down to $930,000. Market did negative 14 year one, balance $793,662. Pretty straightforward. Okay, so here's what strategy looks like. So on the right, you can see there's a life insurance policy now. This is a cash value life insurance policy, and your cash value in year one is $233,000. So what the strategy is telling you is that any year you take a withdrawal and that year is negative, what you want to do is not take a withdrawal the following year. The reason you don't want to take a withdrawal the following year is because the last thing you want to do is take a withdrawal from an account just had a negative return that year. So here, obviously you can see it was negative 14. So we black this out because we're not going to take a withdrawal that year. We're going to make a move over to our life insurance policy and we're going to take out $50,000. So why are we taking out $50,000 instead of $70,000? So we're going to assume a 28% tax bracket. So because when you take money out of a life insurance policy, you can take the money out as a loan. And with a loan, you're not charged tax. So that $50,000 is actually going into your bank account, is going into your hands. So with the $70,000, you got to account for the taxes to be taken out. And then whatever left over, that net amount is what you can use to live off of. So we don't have to worry about the taxes. So we can take out a smaller amount and still net about the same amount of money. So we're going to take out $50,000 from the life insurance policy, right? And then we look at the next year. The next year was also negative. So we know our philosophy is if there's a negative year in the market, we're not going to take a withdrawal. We're going to give our account a chance to rebound, and we're going to take the withdrawal from the actual life insurance policy. Or when I say withdrawal, I mean the policy loan from the life insurance policy. So we're going to take out another $50,000. Okay, so now the next year, the market was up 37%. So you can see your $583,000 received that rate of return and grew to $800,000. That's why we don't want to take a withdrawal when the market is down. So since we're taking a withdrawal now from the 401k or the IRA, we don't take a withdrawal from our life insurance policy. So we do that over a period of time, and you can see we had a negative year here at -7. So we took 50,000. The market did 6, gave it a chance to rebound. So you can see how the strategy is working. So the market historically is up more than is down. So in this scenario, this 20-year period, the market was down 1, 2, 3, 4, 5 times. So there were only 5 times where we had to move over and take money out of our cash value life insurance policy. So which is these 5 years. So what did that do to our account value in our 401k? It gave it a chance to rebound from those negative years. So in the previous example, you saw it was $444,000, but just by not drawing down in these 5 years, it's only 5 years that were negative, because we did not withdraw in those negative 5 years, our new balance is now $3.5 million. So $444,000 from the traditional way of taking money out to $3.5 million from not taking money out when there was a negative year in the market and giving it a chance to rebound, but we moved over to the IUL or, cash value, because cash value does not drop when there's a negative year in the market. So you're protected against losses. So the market could go negative, but you're not going to lose money in your IUL, or you're not going to lose money in your cash value, right? So that's an important component. That's the difference maker in this strategy. So you can see, what is that? That's an 800% increase in available retirement income money. That's huge. That's huge. Just from incorporating that strategy. So just wanted to share that with you guys. All right, so today I'm going over the top 5 questions that I get asked regarding the IUL. Okay, so I'm gonna go one by one. And by the end of this video, you should have a better understanding of how the product works and some of the different features. Okay, so first question I get is, what is the minimum to start? So what's the minimum to start an IUL? And I'm gonna use minimum as max funded. So I'm gonna say the minimum to max fund the policy, right? So max funding, I'm using guideline annual. So that's the most you could put in, because if you go over the guideline annual, you create a MEC, which is a taxable event. So we don't want to do any of that. So we want to stay within IRS guidelines. So I'm gonna use the guideline annual. So for a 20-year-old, if they want to set up an IUL, it would be $123 a month to max fund an IUL. Right now, I'm a broker, so I have access to many, many carriers. So these numbers may be different than the numbers you got from your local insurance agency or whatever it may be. But these are true numbers. I ran them right before the video to make sure no rates have changed. So I'm looking at the minimum death benefit someone can get, and the maximum cash value is a max funded policy. So if you're 20 years old watching this and you have $123 a month, you can get started in the IUL and have it max funded for max cash value. Now, if you're 30 years old, that's $160 a month. So $160 a month will get you a max funded IUL at 30 years old. If you're 40 years old, that's $213 a month to get a max funded IUL. And if you have questions, or you want to see these numbers, or you want to talk about it, I'm also including another link in the description box below. Those will be more for people that, are on the client side, not necessarily agents that want to work with me, but more clients to, get help with the product. So now moving on to 50-year-olds. So if you're 50 years old, to max fund an IUL will be $291 a month at 50 years old, right? And these numbers impressed me. I didn't know they were going to be as low. Now, obviously, you can put in more. So if you put in more, we'd have to adjust the death benefit, but you could put in more. But if somebody says, I want a max funded policy with the smallest amount of money out of my pocket, this is what it will be. Now, because these policies are max funded, that you can put in less, right? It's easier to go down than it is to go up. So if the 50-year-old came to me and says, hey, I know the max funded amount is $291 a month, but can I get it started with $225? I'm going to tell them, yeah, we can get you started. Obviously, you want to max fund it. That's the goal, of max fund it. But at least it's locked in. Your grandfather into the price because we never get younger, because age is a big factor in the cost of insurance. So we never get younger than we are today. So at least that's locked in. And down the line, you can start max funding it. The sooner, the better. So I would say it can even go down to a lot less, right? Because there's a minimum threshold and maximum. So if you reach out, we can give you the range that you can get in so you can actually get the policy set up. So 50-year-old will be $291 a month. And the last one I ran is a 60-year-old. So if you're 60 years old and you want an IUL and you want it max funded, $412 a month will get you a max funded IUL. All right. So I ran with multiple carriers. This is the carrier that had the least amount. If you reach out, I can help you one-on-one. They're not sponsoring, so I'm not just name dropping companies, but that gives you a good scope, a good idea of how much it would cost to set up an IUL and have it designed for cash value. Second question is, can I lose money in my cash value if the market were to drop? So if the market were to crash. So the answer is no. So the market dropping does not negatively impact your cash value. So your cash value inside of an IUL is an index strategy. And what it's doing is following an actual index. So the index is the actual market. The strategy is the formula for which it follows that market. So if the market goes up, typically IULs, I'm going to use the cap, right? Not all IULs have caps, but I'm going to use the cap. So the IUL has a cap and a floor, meaning the cap, let's say the cap is 10%, that's the most you can get. So if the market does 5, you'll get 5 credit to your IUL, 5% credit to your IUL. If the market does 10, then you get the 10% credit. But if the market does 15 and the cap is 10, you still only get 10% credit. So that's the cap. But there's also a floor, meaning if the market were to go negative 10, you're locked in at 0. So zero's your hero is what they say. So you're not gaining any interest, but you're not losing any money because your money's not directly in the market. It's mirroring whatever the market does with that floor and that cap, right? So you have the ceiling, the most you can get. Why is someone willing to have a cap on their funds? Because they like the fact that they have the security, the safety net. If the market were to crash, they're not going to lose any money based on negative market performances. Next question is, how soon do I have access to my cash value? Okay, so assuming we're max funding the policy, so you have money going to the cash value immediately, it varies from carrier to carrier. The one carrier that I know of allows policy loans as early as 15 days. A lot of companies are at 30 days. Some companies are at 1 year. So that's an important question to ask. Obviously, if you're looking for funds within a year, you want to make sure it's accessible to you because that'll be defeating the purpose. But you want to speak to your agent so they can, instruct you like, okay, this policy is a year, this policy's 30 days. There's going to be pros and cons. So let's say the year policy has other features that you like, then the 30-day policy doesn't. But you don't plan on taking policy loans within the first year, so you can kind of bypass. Even though it sounds great, you can have loans in 30 days. If it's not fitting your overall picture, it may make sense to go with the one that gives you loans after a year. If you don't plan on taking loans for 10 years, it's not going to matter either way. So 15 days is the soonest. I see a lot of 30 days, and then you also have 1 year. Next question, do I have to pay back my policy loans? Okay, so the direct answer is no, but I need to give you some context. So if you have cash value built up, let's say, I don't know, you're 5, 6, 7, 8, 9, 10 years out, and you have cash value built up and you decide you need to use the money to do something. I don't know, you got into real estate, you want to do something with some real estate or whatever it may be, you pull the money out, okay? Now, you don't have to pay back that loan, but I always tell people that the alternative would be you getting the money from a bank. So if you got the money from a bank, you would pay back that loan. You'd have to pay back that loan. So I always say treat your own bank. So if you're going to treat this like a bank, treat your own bank with the same respect that you would treat a institutional bank, right? So, but you don't have to be as rigid on yourself. You don't say, okay, I start making payments immediately. You may say, I'm not going to pay back for another 2 years, but pay it back, right? If you can, right? So in that situation, I would say you want to pay it. You don't have to, but you want to pay it back. Now, in the sense where you're retiring, so let's say you're using this for a tax-free retirement income stream, then in that situation, do not pay it back because it makes no sense to pay back a loan in retirement. In retirement, you're trying to reduce the amount of money leaving and you're just taking more money in. So what happens is, let's say you have $100,000 in your cash value and you've taken out $80,000. So you have an $80,000 outstanding loan and you were to die. The insurance company has used your $100,000 as collateral to give you the $80,000 to begin with. And why? Because they know if you can't pay back the loan, they'll take that $100,000, pay back themselves the $80,000, and then they'll make themselves whole. So it's like the buy, borrow, die method. So you don't have to technically pay it back because it will be paid back on your behalf based on the amount that you have inside your cash value, which would be connected to your death benefit anyways. So no, you don't have to pay it back, but depending on what stage of life you're in, determines if it makes sense or not to pay it back. And the last question is, how does this affect my taxes? So money going into the policy is after-tax money. So after-tax money means, you got paid at your job, taxes were removed, and then whatever was left over made it to your bank account. That money that's in your bank account is after-tax money. You've already paid income tax of that money. So that's the type of money that goes inside of a life insurance policy. It receives after-tax money. Once it goes into the policy, it grows, and whatever the growth is, you're able to access that money tax-free. So if you've put in $20,000 in premium, but then your cash value says $100,000, you're able to tap into that $100,000 and not have to pay income tax on that money at all, right? But when it comes to like writing off, it's not going to do anything for you when it comes to writing things off. Obviously, if you have a business, that's a different scenario when you get into business and corporations. But essentially, the money that you put into the policy is not a tax deduction. However, all the growth and all the accumulation you receive out of the policy when you take it out, you're able to bypass taxes 100%. Because when you're taking the money out, you're taking the money out as a policy loan. And loans are not taxable. You pay interest on loans, but you do not pay taxes on loans. And obviously, when you die, then whatever the balance that you didn't use plus your death benefit pays out to your beneficiary income tax free. So that's how it works when it comes to taxes. So today we're talking infinite banking, and I already know the concept of infinite banking is not easy to wrap your mind around, but I'm gonna do my best to make it simplified so you can understand exactly what it is, how it works, and you can decide if it's for you or not. So infinite banking is a strategy where you're gonna use a cash value life insurance policy to purchase things that you would already purchase without it. And right off the bat, I understand that sounds crazy, but trust me, it's gonna sound a little crazier before it starts to make a little more sense. So the normal process looks like this. You get paid from your job, the money hits your bank account, and then from there, you use that money that's in your bank account to purchase whatever it is that you're trying to buy. It's pretty straightforward. There's no confusion behind that. Now with infinite banking, what they're saying is you're gonna get paid the same way. It's gonna go into your bank account, but then from your bank account, you wanna put it inside of a cash value life insurance policy and then use that life insurance policy to purchase the things that you wanna purchase. And I definitely have to include that the structure of your life insurance policy absolutely matters. So it must be structured for cash value and it needs to be accessible whenever you need it. So you can't have one of those policies where it takes 10, 15 years to build up cash value. It needs to be building up cash value immediately when you open up the policy. I also want to note that with these cash value policies, typically it's going to be at least 30 days before you start accessing money. Okay, so why in the world would it make sense to put the money inside the life insurance policy first when I have the money and I could just buy the item myself? So to help explain it, I want to go over a few concepts that typically show how we make purchases on an everyday basis. So one method we use is the financing and debt method. So in this method, what you do is you finance an item, right? You get a loan from the bank and you buy the item with that loan, and then you spend a period of time paying back that bank or that institution the loan plus interest. So you go into debt and then you spend time paying off that debt. Okay, so here's a visual of what that looks like. So you start off at zero and then immediately you get a loan. So you go into debt, and then let's say we're buying a car in this example, and you spend the next 5 years paying off that debt. And once that debt is paid off, you're back at zero. So you're no longer in debt, but there's no money saved. So you're back at zero. Then you do that again, and you do that again, do that again, and you do that again throughout your lifetime. You go into debt, you spend a period of time paying off that debt, and you're back at zero. So remember, no matter what, you end up back at zero. Now, the second method I want to show you is the complete opposite. So this is more of the like Dave Ramsey type method where he doesn't believe in debt. You need to save up the money first, and then once you have the money, then buy whatever you're trying to buy. So you start off at zero, you spend a period of time saving up money, right? And then once you have enough money, you buy whatever you're trying to buy and you spend it back down to zero. Then again, you save up money again, back to zero, save up, back to zero, save up, back to zero, save up, and back to zero. So in this situation, you're not going into debt ever, but guess what's common? You're going to constantly end up back at zero, whether you go through the debt method or you go through the savings method. You're constantly ending up back at zero. So what the infinite banking strategy is doing is they're kind of doing a hybrid of both, right? So they're going to use the debt method and use the saving method, bridge them together and create a strategy called infinite banking. So instead of saving money or financing, you're going to save money inside of your policy, inside of the cash value. And once that money has built up in your cash value, then you're not going to spend it down. You're going to borrow against your policy. And the reason you want to borrow against your policy is because, so let's say you have $80,000 in cash value and you want to borrow against it for $50,000. When you get that $50,000, it actually comes in the form of a loan directly from the insurance company. So it doesn't come out your cash value. It comes as a loan from the insurance company, and the insurance company is going to charge you interest rate. The reason that's so significant is because since the loan came from the insurance company, your entire $80,000 is still parked inside your cash value, earning compound interest, uninterrupted compound interest. So over time, you're going to pay back the insurance company. And once that loan has been paid back, you're not back at zero. You're at a higher watermark. The reason is because, remember, that entire amount of money was still parked, earning compound interest. So that extra money made must be accounted for, which means you're not back at zero. And then you do it again. And every time you do it over and over, since you have the uninterrupted compound effect, you're going to constantly earn interest on every single dollar that you've borrowed against throughout the life of the policy. So that's more of the method of infinite banking, is bridging the gap between the going into debt or financing and saving up your money and spending your money. It creates like a hybrid effect. So I want to show you an example using numbers of what this would look like. So let's say you were going to finance a car and the car is $50,000 and you're getting a 5% interest rate and you're going to pay it over a 5-year period of time. Okay. Now your monthly payment will be $943. That's what you would have to pay the bank or credit union or whoever you use to finance the car. Now, over that 5-year period of time, you would have paid $6,613 in interest alone. Because remember, you're paying interest back to that bank. So your total payments would have been $56,613. So your $50,000 car would have cost you $56,613 if you were to finance it with a bank. Now, with infinite banking, you're looking at your policy as your own bank. So instead of it being to a bank, you're going to use your own cash value as the bank and leverage your cash value to get a loan from the insurance company. So since you know the payment was going to be $943, you're going to use that payment and pay yourself back with the same terms that you would be paying back the institutional bank. So I always tell people, if you're going to use this strategy, treat your own bank with the same respect that you would treat an institutional bank, because you have to pay them back a certain amount of money every single month. So you pay yourself back a certain amount of money every single month. So here's what it looks like. So you got a loan from the insurance company for $50,000, assuming it's a 5% interest rate that's being paid to the insurance company. So you're not paying yourself back interest. You're paying that interest rate to the insurance company, and you're going to do it for 5 years. So you already know mathematically, 943 over 5 years will be $56,613. That's what's being paid back to the insurance company. And after 5 years is up, your loan is completely paid off and you owe the insurance company nothing. But at the same time, since your $50,000 was technically not touched, it's still sitting in that cash value account getting compounded growth. So that $50,000 grows at 5% over 5 years. So we're going to assume you're paying 5% and you're earning 5%. So I'm not assuming you're getting the extra spread or anything like that. Assuming it's a wash loan, 5 versus 5. You're paying 5 and you're earning 5. So it seems like it should be the same number, but that's not how compound interest works. So that 50,000 is earning 5%, and you do it over 5 years, you have earned $14,200 in pure interest on that 50,000. So the ending balance would have been $64,200. So you paid off your loan, but at the same time, your money still compounds and would have grown to 64,000. So of course you have to factor in the cost of the loan. So net, you would have made $7,586 during the process while you've been paying off your loan. Why does that happen? Because you have a loan for $50,000, but you're making a $943 payment every month. So every month you're dropping that 50,000 smaller and smaller. So eventually it's to the point where you're paying 5% on 30,000 and you make some more payments over time. Then it gets to 20,000, then it gets to 10,000. Eventually it's paid off completely. So what you're paying is on a smaller number every time you pay down that loan every single month. Versus on the compounded growth side, that 50,000 is earning interest. So now that 50,000 plus the interest is earned is also earning interest and becomes a compounding effect. So this is the infinite banking strategy of why people use it and why you can get a 5% interest rate credited towards you and pay a 5% on a loan that you're paying down. But because of how compound interest works, you can actually make a $7,500 spread on a loan over a 5-year period using $50,000. Now, people use this to buy cars, people use it for real estate. You can use it for whatever you want, but these are just numbers behind it, and you can decide if it's something that you want to look into further or not. If so, you can reach out. We can help you with it. So I hope this video helped with the infinite banking concept. If you have any questions, put them in the comment section below. Whole life insurance is one of the most misunderstood financial products, period. And I believe it comes from both sides. You have the agents on one side that are, trying to sell the product, so they're making it seem like it's something that is not. And on the other side, you have people that just hate the product, that just have their own opinion and don't like it for whatever reasons. The challenge is, I think both sides overinflate what they're saying. They try to make it worse than what it actually is or better than what it actually is. And that leaves you as the consumer confused. You say, well, both sides seem pretty educated. I don't even know who to believe. So I made this video because I want you to understand exactly how the product works, and then you can decide if it's something that makes sense for you or not. And I'm not sure how long this video is going to be, but I will leave timestamps in the description box below. That way you can go to a specific section if that's something you need to learn more about. So let's start off with life insurance. So what life insurance is a contract with the insurance carrier to where if you pay a premium and you were to die, they're going to pay out a certain amount of death benefit to your beneficiary of choice. So it's simple, straightforward. I live, I pay, I die, you pay, right? So that's exactly what life insurance is. Now there's two types. So there's term and then there's permanent. Now with term life insurance, you're going to have life insurance for a specific amount of time, whether it be 10 years, 20 years, or 30 years. Those are the three most common time frames when it comes to term insurance. Now you're going to pay that premium for that amount of time, and when that time is up, your insurance is over. Well, technically, it's not that it's over. It's just the premium gets so high, nobody even keeps it. So you might as well say it'll be over after that period of time, right? So it's no cash value involved. It's pure life insurance, and it's going to be the lowest premium. Premium just means payment. So it's going to be the lowest payment because you're just paying for pure insurance, and it's only going to last for a specific amount of time. Now, on the other hand, you have permanent insurance. So permanent insurance is going to last either to age 100, 120, or 121, and that depends on the company or carrier and the product. Now with permanent life insurance, you're going to pay that premium also, and that premium is going to cover the death benefit costs or the costs associated with the product, and also there's a second component called cash value, and that cash value is money that can grow for you that you can utilize while you are alive. So cost-wise, it's going to be a higher premium because, for one, the insurance isn't temporary, it's considered permanent, meaning the life insurance company knows they will have to pay out a death claim one day. So of course, it's not going to be as cheap as a term insurance policy where there's a high chance you will outlive that term. And I'm not saying one is better than the other. They're just different products with different goals. Now, underneath the category of permanent life insurance, one specific type is whole life, and that's the one we're going to focus on today. Now, what I want to do is start off by clearing up some misconceptions. So one is that whole life is a great investment or whole life is a horrible investment. So neither one is true because whole life is not an investment. It is a life insurance product. Now, when it comes to someone saying whole life is a horrible investment, what they're doing is they're looking at the performance of whole life, meaning the amount of interest you can earn in the whole life product, and comparing it to what you can earn in the stock market. So I don't think that's a fair comparison because they're not the same product. One's not in the stock market, one is. So when you look at money, there's different asset classes. They're going to be ultra aggressive and there's going to be ultra conservative. So you'll have things like crypto, which is ultra aggressive, then obviously stocks, index funds, things like that. Then you have bonds, you have commodities like gold, you have high yield savings account, you have cash in the bank. So there's several different asset classes for your money. It's not fair to compare one asset class to the next because they have different goals. Meaning if somebody says, oh, I have all this money in gold, no one's going to come up to them and say, oh, you're dumb for having that money in gold. The S&P has returned 12%, 11%, 10% for the last 20, 30, 40 years. No one's going to say that because gold is a different asset class than investing directly inside the stock market. So I'm not for the theory of comparing the performance of a whole life product to the performance of the stock market because you're not locked into one. You can have a whole life product and have money inside the stock market. It doesn't have to be one or the other. You can have both. So the comparison where whole life is a great investment or whole life is a poor investment doesn't need to be had. Whole life is its own specific product and has its own specific goals. If I was going to classify it as something, I would classify whole life as a savings alternative. So versus having money in the bank, you have your money inside whole life because you're going to get a better performance. I'm not comparing the performance of a whole life product to the performance of Bitcoin or the S&P 500 or something like that. It just doesn't make sense at all. Now, the next phrase that I hear a lot that I want to address is that whole life is not a retirement plan. And yes, that is true. Whole life is not a retirement plan, but I believe people are saying that, guiding people and misdirecting people. So with whole life, there is cash value you can build inside the policy. Now, when it comes to your retirement year, there is money inside that policy that you can use to pay for your retirement. So when you say whole life isn't a retirement plan, yes, it's not a qualified retirement plan. It's not a 401k plan. It doesn't follow ERISA guidelines or anything like that. But look at it like this. If you have $500,000 in your cash value and you're getting ready to retire, guess what? You can use that cash value for retirement money. Just like if you have $500,000 in the bank, that's not a qualified retirement plan, but you can use that money for retirement. And I think that's all people care about is I want money I can use when I'm retired. And just as much as people are using whole life not being a qualified retirement plan is a bad thing, it can also be looked at as a good thing because since it's not following certain guidelines and qualifications under ERISA and things like that, you don't have to wait to a specific year or a specific age to start accessing that money 100% tax-free. Meaning if somebody wanted early retirement, they can actually use their cash value for early retirement. So it's all about who you're hearing the message from and how they're spinning it to benefit them and whatever their agenda is. But whole life is not a qualified retirement plan, but it is money you can use for retirement, just like you can use money inside of a brokerage account, just like you can use money inside your bank account. All someone cares about is when I retire, is there money I can use to live off of and pay my bills? Now, the next point I wanted to address is the saying that whole life takes years to build up any cash value. Now, that can be true. That's another one of those things that can be true, but it's not an absolute because it depends on your structure and the type of policy you have. Because essentially there's two different types of life insurance companies. One is called a stock company. So stock company, they're owned by shareholders. So just like if you bought Apple or Google, Amazon, people actually have stake inside that life insurance company. Now, when a company produces profits, it can reward a portion of those profits to its shareholders in the form of a dividend. So dividend is just taking a portion of the profit and paying it out to the shareholders of the company. Pretty basic, just like any other stock or whatever. They don't have to do it, but they can issue a dividend to the shareholders. Also want to point out that that dividend that pays out to the shareholders is a taxable dividend. So they will have to pay tax on the dividend received. Now, on the other side, you have mutual and mutual holding companies. So these life insurance companies are actually owned by policyholders versus the shareholders. So because the company is owned by policyholders, they have the chance to participate in the dividends themselves. So it's a little different, but it's still a portion of the profit that the company earns. Instead of being paid to stockholders, it is being paid to the policyholders. Now with those mutual holding companies, some of those companies will pay out a dividend to the policyholders. Now the policies that do allow the owner to receive dividends, those will be considered participating policies. Now on the other side, the ones that don't receive dividends are non-participating policies. And what are they participating in? They're either participating or not participating in the dividends. So that's the difference. So you hear participating company, that means they're participating in receiving the dividends or paying the dividends to the policy holders. So here's an example of a non-participating whole life insurance policy. These are also referred to as traditional whole life. So if you look at this, you can see the client is 30 years old. Their death benefit is $1.6 million, and they're putting in $1,000 monthly. So here is the annual payment into the policy. The annual premium is 1,000 times 12, 12,000. And here you see the cash value. So you see there's 0 year 1, 0 year 2. So yes, this policy, it does take time to build cash value. So you've put in $60,000 after year 5, and you've only have $29,000 in cash value. And your death benefit stays the same regardless of the cash value input. So this is traditional whole life. And if I fast forward, you can see year 16 is the break-even period. So that's where your cash value is more than your total contributions. And even with it being the break-even period, I know that's something that a lot of people look at. It only really matters if you're going to cancel the policy and walk away with the cash, because essentially you have a $1.6 million death benefit. And I don't know too many people that think they're going to get a $1.6 million death benefit for free. So they understand there's going to be costs baked into the policy. So even with that being said, even with the cost, you still break even at year 16. Now, another thing about whole life is that there's a guarantee. The guarantee is that that cash value is going to equal the death benefit at policy maturity. So no matter what, you've contributed this $12,000 a year, and it's guaranteed to grow. As you can see, year by year, it's going to continue to grow more and more. And at policy maturity, right here we have at age 120. Age 120 at policy maturity, you can see the cash value is equal to the death benefit. So that is the guarantee you are getting when you sign up with a whole life policy, whether it's traditional, participating, non-participating, it doesn't matter. And that's important to understand, that that guarantee is intact. The insurance company is obligated to make sure your cash value equals your death benefit. Now, a second type is more of a paid up. So this is more of a paid up. So if you've heard of a 20 pay, that means you're going to pay into the policy for 20 years and then you're done. So this is comparing the two. So instead of the $12,000, because you're getting the same death benefit, but instead of $12,000 a year, almost $20,000 a year. So $19,946 going in a year. So you have cash value a little sooner. It doesn't look that great, but it's still sooner than over here where you're at 0. The break even for this policy is year 11, which is a lot sooner than the year 16 that we saw with the previous policy. So, and you can see the cash value is $113,000 versus $222,000 here. But even when you stop paying at year 20, it's still obligated that no matter what, as you move forward, when you reach the maturity of the policy, it's still going to equal $1.6 million. So whether it's an early pay, whether it's a full pay to pay age 100, because you can see this one paid to age 100 here, it doesn't matter. And all that means is once you've paid into this policy for 20 years, that means the payments are enough for that compounding effect to equal the death benefit at maturity. So that's a short pay, 20-year pay versus a traditional. They're both traditional, but one's a short pay, one's a pay to age 100. So that's the traditional policy, no dividends, just pure guarantees. So now we move over to a participating policy, meaning they're participating in the dividends, and it is structured for cash value. Versus the other one, you didn't have a lot of flexibility. This one's going to be structured more for cash value. So same 30-year-old, right? But you notice the death benefit is a lot smaller, right? Instead of 1.6 million, you have 231,000 in year 1. We're putting the same 12,000 into the policy, 12,000 a year into the policy. So that's the same. Only thing we change is the structure and the death benefit amount. So here, we're looking at here, this is your cash value year 1. So you put 12,000 in. Year 1, the cash value is $10,638. This is with dividends. Without dividends would be the guarantee. So you see you have the guarantee here. That's without dividends. Non-guarantee means you're adding dividends. However, even though dividends are not guaranteed, most insurance companies that offer dividends have paid out dividends every year consistently for over 100 years. So even though it's a not guarantee, it has paid out. The reason it's more of a not guarantee because the amount, it changes from year to year of what they pay out. And I'll go over more detail about dividends and how it pays out and things like that. But guaranteed, you put in 12,000, a little more than 10,000 in your cash value in year one. That's a huge difference from the traditional policy we just looked at because of the structure. So it doesn't have to take years to build up any cash value. It could be cash value available right out the gate if you structure it right and you have the right type of policy, right? So I tell people your agent is the most important part of the process. So forget about the different companies. You want to have an agent that has access to multiple companies and knows how to structure a policy so you can get this done, right? So here, when we look at the non-guaranteed with the dividend, you can see the break-even period is year 5 versus year 16 in the traditional policy. Huge difference. So you've put in 60,000, which is just a 12,000 over 5 years. You put in 60,000, and your cash value is a little more than 60,000. And then you can see your death benefit, although it started off lower, is getting driven up every single year as the policy starts to accumulate, right? So with some additions, I'll go over the additions and how that's happening, but you see your death benefit is increasing every single year, and your cash value has broken even at year 5. Now, another thing to mention with this policy is the payments. So this contract premium, that's your payments into the policy. So you can see here at year 17 with the non-guarantee was the break-even period. So you can see you've put in $204,000 and the guaranteed cash value is $205,000. So this looks more like traditional policy, but not quite because you still have early cash value. But as far as the break-even period, it mimics the traditional policy. But you can see as you go on, right, the payment drops at age 61, right, because you have some additions that fall off due to the structure. And then the payment drops to $1,200 at age 67, and then you stop paying at age 76, no more payments going in. And then the policy still is obligated to continue to compound and grow because your cash value must still equal your death benefit at maturity. So this one matures at age 121. At that point, you're looking at $6.2 million in cash value compared to the 6.2 in death benefit. And on the guarantee side, $747,000 in cash value versus the $747,000 in guaranteed death benefit. So those obligations are still there. They're still guaranteed that the cash value will equal the death benefit, whether it's participating or not participating. But that shows you the difference between the different types of policies and how structure could come into play and make a huge difference. Okay, so now that you've seen the difference between a traditional non-participating and a participating policy based on the dividends, let's take a deep dive into what these dividends are. Because again, like I said before, dividends are not guaranteed, but they have been consistently paid out by companies for well over 100 years. So most companies do not miss their dividend payments. So your dividend is made up of 3 different parts. You have your expenses. So expenses are just operating the company. You know, you have your expenses to the company. So the better the expenses, the more the dividend can be. Also the mortality. Mortality is just the assumption on how many people the company think is going to die that year versus how many people actually do die that year. So the difference in mortality does affect the dividend rate. And the third is the actual investment account. So they have an investment account, and based on the performance of the investment account, that affects the cost of the dividend as well. So to recap, you have mortality, you have expenses, and you have the investment account. Those 3 categories make up your dividend. So your dividend payout is made up of those 3 categories combined. So remember when we looked at the participating policy example, there was the guaranteed column and there was the non-guaranteed column. So that guaranteed column is what the insurance company is guaranteeing they're going to give you. So they have to be very conservative to say they're going to guarantee you something until your age 120 or age 121. So with the non-guaranteed category, what they're doing is first looking at the mortality rate. They figure out, okay, what is the worst case scenario? So we understand a certain amount of people die every year, but what if it got really extreme? So they look at a really extreme case of if way more people died than expected per year, and they factor that in. Second thing, they look at the expenses. So let's say we did a horrible job at managing our expenses. How bad could it really get? And they plan for that. Third thing, they look at their expenses. Okay, what's a worst case scenario we see us getting in our investment portfolio? And their investment portfolio is mostly bonds. Bonds take up the majority of it. But they say, even with that being said, what's the worst case scenario? And they look at the worst case scenario. So they're giving the worst case scenario with mortality, worst case scenario with expenses and worst case scenario with their investment account. So they look at the worst case scenario and they apply it to the policy, and that's where the guarantee column comes from. So pretty much it's there to protect you in case everything went wrong. Some people look at it as a bad thing. Some people look at it as a good thing, because if you're putting money in a company, you want that company to be prepared in case the worst case scenarios hit the fan. And that's exactly what they're doing when it comes to that guarantee column. So now when we move over to the non-guarantee column, this is what really happens. So they plan for the worst case scenario when it comes to mortality, but not as many people died. Okay, so that means the cost is lower and they send that cost back to you. Then we look at expenses. They plan for the worst case scenario with the expenses, but they did a pretty good job managing their expenses. So there's extra money that gets sent back to you. And then they look at the investment portfolio, and their investment portfolio actually performed better than the guaranteed. They say, oh, there's extra money, and they send that money back to you. So some people look at it as a return of unused premium. Some people look at it as a return of overcharged premium, but either way, it comes back to you. Now, one good thing about it being looked at as overcharged premium is that because it's classified as premium that you've already put into the policy, when you receive it back, it's still going to be a tax-free dividend. So that's the difference between receiving dividends in a stock and receiving dividends in an insurance company, is because just as long as you're under cost basis, that return of profit can be classified as a return of premium, which classifies it as tax-free, because returning your own premium is tax-free because you've already paid taxes on that premium before you put it into the policy. So it's like the workaround. So it's all perspective of how you look at it, but dividends inside life insurance policies are tax-free, and that's how looking at it as a return of unused premium or overcharged premium can be a good thing, because you get those tax benefits. So I want to show you this example because I understand dividends can be hard to wrap your mind around, and I'm a visual person myself. So I want to give you guys these visuals so it helps you understand the process. So let's say you had two accounts. You have a spending account and you have a bill account. So that spending account, you're going to spend to zero every single month. You can do whatever you want with it. And your bill account is specifically for paying your bills. So the money has to be there to pay the bills because you can't pay them from your spending account. So obviously you're going to have to send money to your bill account every single month so that when your bill comes due, there's money to pay that bill, obviously, right? So let's say you have $3,000 that comes in to your spending account from you being paid monthly. Immediately, you send over $300. Why do you send over $300? Because every month you understand your light bill, let's just say it's a light bill, your light bill is $50 per month. But even though your light bill is $50 per month, you do the math. You say, okay, I have a TV, I have a refrigerator, I have 3 rooms, I have 100-watt light bulbs. So you're looking at what's the most amount of energy I can use. If I left these lights on 24 hours a day, 7 days a week, I left the refrigerator door open, I left the TV on high, and I'm looking at what is the maximum the electric company can charge me per unit. And I say, worst case scenario, if I did all these things wrong, the worst my bill could ever be is $300 a month. So you send $300. So you're never worried that your bill is going to be higher than $300, because mathematically it's impossible for your bill to be $300, but you're planning for the worst case scenario. You're super conservative. So you send $300 over and it's sitting in your bill account. Then when your bill comes due, surprisingly, it's $50, right? It's normally $50, but you plan for the worst. So what happens is, because it's $50, that remaining $250 gets sent back to your spending account and you can spend it on whatever you want. So it's kind of like how they do it when it comes to the guarantee and non-guarantee. So they're overcompensating for fees that may not happen, but it's possible that it could happen. And when those fees actually don't happen and they get the true numbers, whatever's left over, they send it back to you, and that's in the form of a dividend. So that's kind of like how I hope that visual will help you guys. So now as you have that example down packed and it kind of makes a little more sense. If it doesn't, maybe you go back and watch it. Now I want to show you an actual company paying out dividends. So this is a company, if I said the name, you'll be aware of what the company is. And they have a dividend interest rate of 5.15 for that year. That's what they quoted as far as what they're paying out, 5.15. So you'll see exactly how it's applied to the non-guaranteed and to the guaranteed side. So this will give you total clarity right here. So the first thing we're going to look at is the guarantee column. So this is the policy value at the beginning of the year. So $90,772 at the beginning of the year. So then you have the annual premium. So the premium is the payment the actual client made into the policy, right? So that's the payment, bringing the new balance to $92,351. Pretty straightforward. Where they started, they added money, where it is now. Then we have the mortality and expense charges. So we're going to combine those two together. So the mortality is the amount of people that died. The expenses are running the operations of the company. So together, they're going to be almost $1,900, $1,893 in expenses they're going to charge your account on the guaranteed side. So after the charges, that brings the balance down to $90,458. Then there's a guaranteed interest rate. This is from their investment portfolio. They know their investment portfolio is going to spit out a specific guaranteed worst case scenario rate, and that's what they're giving you, $3,694 guaranteed. So the end of year policy value will be $94,152 on the guaranteed side. So that is what's guaranteed. Okay. So now we move over to the non-guaranteed side, and you can see how both of them are different and how it applies. So same thing. So top three are the same. So you have the starting value, their contributions the same, so the ending balance is the same. So now when they actually ran the numbers, their expenses and mortality charges were not $1,893. It actually came out to $477. Okay, that's a lot cheaper, okay? So next, after you subtract that, that brings the balance to $91,874. Then as far as their investment portfolio, the investment portfolio performed well and did better than what the guarantee said it was going to do. So now we're looking at adding $4,731, bringing your non-guaranteed value to $96,605. That's the difference between the guaranteed side and the non-guaranteed side. So it's the assumption of worst case scenario versus what we actually did. So when we actually did those numbers, we're giving that money back to you. And obviously with the investments, we're giving you the additional growth of the investments. So the difference, so there's $1,416 coming back in the form of expenses and $1,037 coming to you in better accumulation from their investment portfolio, right? So your total dividend is $2,453. So your total dividend is not the same as your dividend rate. So your dividend rate is only showing the investment portfolio and what it's giving you into your account. So it's not the full dividend, it's the dividend rate. So it's important to understand that your dividend interest rate, or the DIV, is not the same as your total dividend. Your dividend interest rate is only talking about the investment portion, not accounting for the mortality and the expenses. So total dividend, $2,453. So that's hopefully that clears it up to show you what the difference is. So different companies have different ways of quoting their dividends. So try not to get caught up in who's paying out a certain dividend, because they have different ways of calculating their dividends. So I was just focused on it being a solid company. It is consistent with paying out a dividend, but more importantly, you have a strong agent that's going to guide you in the right direction, that's going to help you structure your policy to meet the needs that you're trying to accomplish. So now that we have a better understanding of what a dividend is and actually where it comes from, I want to talk about the different ways the dividend can be paid out. So for one, the dividend can be paid out in cash, meaning you could just receive a check for your dividend, which is great. And just as long as you're under your cost basis, it's going to be tax-free as a return of premium. So that's one way. So they cut you a check. Every time there's a dividend, you receive the check. You could do whatever you want with the check. Second thing you could do with your dividend is you can actually leave it parked with the insurance company in like an eternal savings account, and it's going to spit out interest to you. Now, you have to understand that interest that it pays you is going to be taxable. So it's not like receiving the dividend in cash. If it's inside their interest-bearing account, when you earn that interest on that money will be taxable to you. So you can receive the full dividend in cash, or you could leave the dividend parked with an insurance company inside an interest-bearing account, and you receive the interest payments, but those interest payments to you will be taxable. Third thing you do is you can pay down your premium, meaning let's say your payment is $1,000 a month, but your dividend is $300 a month. You can actually have that dividend pay part of your premium. So out of pocket, you're only responsible for paying $700 a month. So you have your $700 payment plus the $300 coming from the dividend equals the full $1,000 of premium that's going into the policy. So you can pay down your payment, your premium payment, using your dividend as well. Another thing you can do with your dividend is you can actually pay down your loan. If you have an outstanding loan, you can have, assuming it's a $300 dividend that's paying out, you could have it pay off that loan on your behalf. So you continue making your normal payments to as new premium, and then the dividend you receive actually pays down your policy loan, which is another great feature you could do with a dividend. So dividends have a lot of flexibility. And the last thing you could do with a dividend, and when I say last, doesn't mean it's guaranteed last. Different companies and products have different specifications of what you could do with a dividend. But the last one I'm going to cover is the one most commonly used. And that's using your dividend to buy paid up additions, or PUA, right? Paid up additions are just additional life insurance policies. So it's like you have money that pays out, and that money that pays out is going to buy paid up addition, which is small little life insurance policies that look like your current life insurance policy. So it might be kind of hard to wrap your mind around it, but I'll do my best to explain it to you. So let's say the dividend that pays out is $100, okay? So that $100 is going to buy a paid up addition. So all it is a single paid up policy, meaning it's a policy that's paid up, but it has the same rules. The cash value must equal the death benefit by age 121. So the unique thing about paid up addition is as you put that $100 in, about 95% of that goes towards cash value, and 5% of that pays for the death benefit. And usually the death benefit is about 3 to 5 times of what you're putting in. So you have a small death benefit that's 3 to 5 times the contribution, but 95% of that money, usually it's about 95, it could be 90, but usually about 95% of what you're putting in is pure cash value. So this is one way to accelerate your cash value like nobody's business. So when we go back to the illustration of the participating policy, you can see this death benefit is getting higher and higher because that dividend that's paying out, you can see this dividend here, shows you the annual dividend is paying out, is buying more paid up addition, which increases the death benefit and increases the cash value. Because remember, about 95% of what that dividend payout is going to be pure cash inside of that cash value, but at the same time is buying 3 to 5 times that amount worth in life insurance death benefit. So the paid up addition is the way that this dividend is getting higher and higher every year, and this death benefit is getting driven up along with the net cash value growing as fast as it's growing. So it's like the accumulator when it comes to making your policy perform at optimal speed. So using a visual, this is kind of what it looks like. So as the money goes in, about 95% of it's going to go to the cash value, and then 5% of that is going to be buying the death benefit. And again, the death benefit is about 3 to 5 times of what's contributed. Now, the unique thing about paid up addition is that you have your regular life insurance policy that you started off with, and that policy is earning dividends. We already covered that. It's earning dividends. Now, when that dividends pays out, it buys this paid up addition insurance. Now, the unique thing about it is that now your original policy plus that additional paid up addition insurance are both earning dividends, right? So now the next year you have dividends coming from both places, and then that dividend payout buys more. So now you have all these dividends paying out, buying paid up additions, which are earning more dividends, and the compounding effect starts to kick in. So you can imagine, because now you have the compounding of these paid up additions, buying more paid up additions, buying more paid up additions, and that's how that cash value starts to compound and grow so fast. And this is why with all the things you could do with the dividend that's being paid out, buying more paid up addition is the most effective, and that's why it's the most commonly used, because it makes the most sense. It drives the cash value, it drives your death benefit, because remember, the higher your death benefit, the more guarantees on your cash value, because no matter what, the death benefit and cash value has to be equal. So as you get more death benefit, it makes your cash value perform better because it has to grow faster. So now that you understand how important paid-up additions are, how do we blend them together to create a policy that's going to fit your needs, right? So there's three main parts to a policy. So you're going to have your base life insurance. So that's the base of everything. That's the actual insurance that you're going to have that's going to last age 121. So that's your base. Then we understand we have the paid-up addition where, 95% of that money is going to go towards cash value. So let's say you're putting in $1,000 a month. You say, okay, how am I going to break this up? So depending on carrier to carrier, everybody's different. So you could say, well, I'm going to have 10% of that go towards my base and 90% of that go towards my paid-up addition. Because if I put 90% of that towards my paid-up addition, that means 95% of that 90% is going to be pure cash value. And that's great. Sounds great. That can work. But you have to still follow guidelines. So there's guidelines in place that shows how much money you can put into a policy based on the death benefit size. So in a situation where you put in too much money and you've broken the guidelines of, the guidelines that are set, you can create a modified endowment contract or a MEC, meaning now your policy has broken the guidelines and you lose all the tax favors of the policy. And that defeats the purpose of having the policy. So what we can do is we can add term life insurance to the policy, right? So you blend in a term policy, and the reason you blend in a term policy is because you increase the death benefit. So what whole life allows you to do is leverage the cost effectiveness of a term policy but still be able to capitalize on the death benefit amount. Meaning you can add a term insurance policy to your policy, increase the death benefit for low costs, and that can help you stay within the guidelines of death benefit to premiums paid into the policy. Now, once you start blending these together, your base, your paid-up addition, and the term policy, that's why I always stress that your agent is the most important part of the process, more important than what a dividend that paid out, because it's not always going to be the best fit to do a 10% base, 90% paid up addition with a term insurance blend. Is a term insurance 10 years, 20 years, 30 years? Should I do a base 20%, 80% paid up addition? So your agent's going to have to mix and match. There's no way I could just do a video to show you which one is best for every scenario. Because some scenarios, yes, the 10% base, 90% paid up addition is going to be best. But in other scenarios, it's not going to work out well, depending on what you're trying to accomplish. But blending those three together, staying within IRS guidelines, is going to help you make your policy as efficient as possible and give you that early cash value that you desire. Now, the next area I want to go over is accessing money inside a whole life policy. Now, when you access money, you're actually leveraging against the money that's in your cash value. Okay, so it's not the death benefit. So looking at this policy, I can't borrow against $500,000. I'm borrowing against this $137,000. So that's important to understand. You're leveraging against your cash value amount, not against your death benefit amount, right? And this particular policy loans are available after 30 days. So not all policies allow that, but in this one, you could take a policy loan 30 days against your cash value. Usually it's maybe about 90% of it, somewhere around there. Every carrier will be different. So when you borrow against a policy, for instance, when you borrow against this let's say you wanted $100,000. That $100,000 in most situations, I'm assuming you're going to want to take advantage of the tax efficiency of the policy. So when you borrow against that 137 and you take out 100,000, you're going to take it out in the form of a loan. Now, when you take the money out in the form of a loan, you're going to be charged an interest rate on that loan. So let's say you're being charged 5% on that loan, and that payment is going to the insurance company. Now, at the same time, you're still earning interest on your cash value, because since you got a loan directly from the insurance company, that means technically your money was not taken out of your cash value account. So that cash value will earn interest. Now, there's two different ways this can go, and this changes from company to company. So some companies are a direct recognition and some are a non-direct recognition. So direct recognition means they're recognizing you have a loan outstanding. Now, out of that $137,000, you've borrowed against $100,000. So they may recognize that $100,000 and say, well, we'll give you a full dividend on that remaining $37,000, but that other $100,000 is not going to get a dividend, or it's going to get a reduced dividend. So that's where they're recognizing that there is a loan outstanding, and that affects the amount of dividend that pays out. Doesn't mean it's good or bad. It just is what it is. Now, non-direct recognition, meaning you can have a loan out. In this scenario, you have a $100,000 loan against the policy. It does not recognize that loan, and it pays your dividend out in full on that $137,000 as if no loan exists, because it doesn't recognize your loan. So that's recognition versus non-recognition. And now when it comes to paying that loan back, there's different ways you can pay it back. You pay it back with premium. You can pay it back using your dividends, but it is not required to be paid back. Now, if it's not paid back, it's going to still accumulate the interest on the loan. In the event you pass away with an outstanding loan, it is deducted from the death benefit payout, and then the remaining pays out to your beneficiaries income tax free. So let's look at an example so I can explain what happens during the loan process. Now, let's say you passed away with $100,000 outstanding in a loan. So what happens is that $100,000 will be deducted from your death benefit, and then the remaining $566,000 would pay out to your beneficiary. Now, when you look at that, you may say, oh, well, they're keeping the cash value, but this cash value is already baked into the death benefit. Because if you look at it, you start off with $231,000 in death benefit, and if you added this $232,000, the death benefit would be close, but it wouldn't be as large as the $666,000 of what it is, right? Yes, you got to account for there is some paid up additions in there, but just understand that the cash value is baked into the death benefit. It's not looked at as two separate entities. So your death benefit payout will be a net of your outstanding loan. So if it's $100,000 loan, $100,000 would be removed. Remaining will pay out to your beneficiaries 100% income tax free. So I hope this video helped clear up some of the misconceptions and help gain some more insight on how the product actually works. What's the difference between term life insurance and whole life insurance? And the challenge is there's a lot of one-sided information out there for both sides. And when you read about something or hear somebody talk about it, it seems like they're only giving you the good and not telling you the bad side of it. And we already know there's no such thing as perfect insurance. So I'm going to give you both sides, both the good and the bad. So my goal today is to give you both the pros and cons of both so that you can make the best decision for you and your family. First, we're going to go over term life insurance. Term insurance is pretty straightforward. You get approved for a certain amount of death benefit coverage, and then you just pay the premium. And the premium is just the insurance company's terminology for payment. So anytime you hear the word premium, just automatically associate that with, okay, they're talking about the payment. And that premium payment can be done monthly, quarterly, semi-annually, or even annually. Typically, you'll save the most money the more you pay your premium in advance. For example, I looked at a few policies, and paying your premium annually actually saved you 5% versus if you were to pay it monthly. And the three factors that determine how much you pay for insurance are your age, your health, and your gender. So obviously, the older you are, the more expensive the insurance gets. Also, the less healthy you are, it also affects the policy and makes it more expensive. And it's cheaper for women than it is for men. Now, term insurance is typically offered in increments of 10 years, 20 years, or 30 years. All that means is when that block of time is up, then your insurance is over. So if you have a 20-year policy, you count out 20 years. When it reaches year 20, your policy is over. Now, one of the best things about term life insurance is that typically it's one of the cheapest insurance policies on the market. So it does a great job of fitting inside of a family's budget. Now, when it comes to how much life insurance somebody should have on themselves, typically you want to aim for at least 10 times your income. So if you're making $50,000 a year, you want to at least have $500,000 of coverage on yourself. And term life insurance will give you the most inexpensive way of accomplishing that goal. So as a byproduct, you'll also have more money freed up to do other things like, invest, or if you want to add money towards your mortgage or anything else you want to do, because it's going to be less money out of your pocket. For example, a quote for a 30-year term policy with $100,000 in death benefit coverage for a 30-year-old male who's healthy came out to be about $17 a month. So that can give you an idea of how affordable these policies can actually be. Now, on the flip side, the biggest disadvantage when it comes to term life insurance is that it's only temporary. Like I mentioned before, once that period is over, whether it be 10 years, 20 years, or 30 years, your policy is done. And when I say done, that means you have no more life insurance. And statistically, most people outlive their term life insurance policies, which technically is a good thing because that means you're still alive. But it's important to know that most of these policies never end up paying out. Now, if you were to die during that time frame, the death benefit would definitely pay out to your beneficiary. Now, the sales pitch that you'll hear when it comes to term life insurance is that, oh, you get this 20-year policy, and in 20 years, you'll be wealthy and you'll be technically self-insured with your own wealth, so you won't even need insurance anyways. But in the same breath, they'll tell you that the policies are renewable, so at the end of the 20 years, you can always renew and extend your policy, which is a huge contradiction, and it leads me to wonder if you even believe yourself when you tell me that I'm going to be wealthy in 20 years and I'll be self-insured because I'll have all this money. But unfortunately, statistically, the average person does not end up wealthy at the end of their 20-year policy or their 30-year policy. That's just something I want you to be aware of when you do speak to insurance agents. So more than likely, at the end of that period, whether it be 20 years, you will have to renew your policy. Now, the challenges with that are, one, now you're 20 or 30 years older, which has a huge impact of how much you pay monthly towards that policy. And two, maybe you had a change in your health condition, or maybe you gained some weight over that 20 or 30-year period, which has a huge impact on the cost of your insurance. In some situations, you could have been flagged with some type of health condition or diagnosis which deems you as being uninsurable, which is extremely unfortunate because now you couldn't even get term life insurance even if you wanted to. So those are a few things to take into consideration when looking at getting term life insurance. Now, when it comes to whole life, it's not as simple, mainly because there are a lot more variables that actually go into a whole life policy. The first thing you have to understand is that when it comes to whole life, there are typically two different types of life insurance companies that offer them. There are stock companies and there are mutual companies. Non-participating whole life policies are offered by stock insurance companies, and participating whole life policies are offered by mutual life insurance companies. Now, the difference between a stock company and a mutual company all comes down to what that company does with their earnings. Stock insurance companies can distribute a surplus of their profits directly to shareholders in the form of dividends. And mutual insurance companies can distribute a surplus of their profits directly to the policyholders in the form of dividends. So that's what makes whole life insurance from a mutual company a lot more attractive, mainly because you have the opportunity to earn dividends into your policy. But before we go into dividends and how that actually work in relation to your policy, I did want to go over the biggest disadvantage when it comes to whole life. And that's the fact that it's the most expensive life insurance policy that's on the market. For comparison purposes, that previous policy I mentioned, which was a 30-year term for a 30-year-old male for $100,000 of coverage, came out to be about $17 a month. Now, that same $100,000 coverage in a whole life policy came out to being about $69 a month, which is a difference of $52 extra a month. So you can see right away why somebody would choose a term policy. When you look at the coverage amount, dollar for dollar is just dramatically cheaper. Now, here's why whole life policy is more expensive. Because nobody really talks about why whole life is so much more expensive than term. I mean, it's the same amount of coverage, isn't it? So here's what you're actually paying for if you choose to get a whole life. Whole life policies are considered to be what's called permanent policies. That means as long as you pay your premium, there is a death benefit that is guaranteed to pay out to your family. And with term insurance, the life insurance companies already know ahead of time that there's a 99% chance that you will outlive that policy, which means they will never have to pay anybody anything, which makes term insurance extremely profitable for a life insurance company. But when it comes to whole life, the insurance companies know there is zero chance that you're going to outlive that policy, which means they will definitely have to pay out a death claim one day. So of course, they're going to have to charge more in the meantime. We can't forget that the number one rule of all companies is to make a profit. They just make their profit in different ways depending on which policy we're talking about. Now, your payment with whole life policies is also fixed and is guaranteed to never increase. So when that same 30-year-old turns 95 years old, they still are only required to pay that $69 a month for $100,000 of coverage, which is beyond amazing because most insurance companies don't take on any new clients after they reach the age of 80. So with whole life, you're actually locking in your life insurance policy for the rest of your life. The way the payment is calculated is all they do is determine how much the cost of insurance will be over your lifetime, and they just give you an average. That's why it stays the same consistently for a 30-year-old all the way to a 95, 100, 105-year-old. So the fact that you're paying an average is the reason why your payments will never increase even as you get older. So other than the fact that the death benefit never expires, another thing that attracts people to whole life is the fact that they can have cash value. So here's how that works. When you make your premium payments, there's a portion of that payment that goes to an internal savings account called cash value. So your payment goes into the policy, the insurance company deducts all the cost of the policy, and whatever's left over is what lands inside that cash value. So one amazing feature with cash value is that you're able to overfund your policy to increase your cash value. All that means is that you're paying a higher premium than the policy requires so that that additional money can land inside your cash value. But at the same time, it's extremely important to have an experienced agent that knows what they're doing, because you don't want them to have to increase your base death benefit just because you want to add more money to your cash value, because doing so will give you unnecessary cost, which defeats the purpose of adding more money to your policy. So if you are looking to max fund your policy, you definitely want to look at an illustration first so you can get an idea of what your cash value should look like over the next year, 5 years, 10 years out. And when the policy is structured correctly, you should see cash value in the first year. You don't have to wait 5 years or 10 years to build up any cash value. It shouldn't work that way. But unfortunately, I do see a lot of policies that are set up that way. Just make sure that doesn't happen to you. Also, in participating policies, you'll usually receive a fixed 4% compound interest rate that goes towards your cash value. And an additional 1% on top of that 4% gets added to your policy in the form of dividends, like I discussed before. So when the company makes a profit, they take some of that surplus and actually pay it towards the policy owner's policies. Another feature with whole life is that you're able to take out policy loans. And it's important to know that when you do take a policy loan, you will be charged interest on that loan from the insurance company. And most participating policies charge about a 4 to 5% interest rate on that loan. But a great feature with these policies is that even though you've taken a loan against the policy, you still earn that compound interest of that 4% and that 1% dividend as if the money was never touched. And just so you understand, you could withdraw money from your insurance policy. I know there's a big misconception that makes it seem like you can't, but when you do withdraw from an insurance policy, you do have to pay tax on the gains. So people use policy loans because, for one, it's tax-free, and for two, they still earn compound interest on the entire amount as if it was untouched. So as you pay back your loan over time, you can actually make more money on the interest you're earning on your cash value than the interest you're actually paying on your loan. There's not many places that you can do that. And that's why the loan provision is usually the most attractive area for people when it comes to these policies. So when it comes down to it, some people feel they only need a temporary death benefit for a specific amount of time, maybe to cover a mortgage or maybe just to cover their income until their children become independent. And on the other side, some people want their death benefit to be permanent because they want to guarantee they leave some financial assistance for their family when they pass away. Or maybe they just like the idea of the cash value. And in some situations, people want both policies. But ultimately, it's all about what you feel will help you accomplish your goals. So there's the breakdown on the differences between term life and whole life. 70% of all your wealth will be wiped out by your second generation, and 90% will be wiped out by the third. And I already know that's a hard pill to swallow. So stick around for the rest of this video so your family doesn't end up becoming one of these statistics. Hello and welcome to the channel. Don't forget to like, share, and subscribe if you find any value at all from this video. So today we're going to be talking about generational wealth, and not just how to obtain it, but mainly how to keep it by leveraging your own family bank. So usually there's that one individual in the family that breaks all the barriers and completely changes that family's legacy. And the fact that you're here watching this video dramatically puts those odds in your favor. There are two main families that are usually brought up when anyone brings up the topic of family banking. And that's the Vanderbilt family and the Rockefeller family. And these happen to be two of the wealthiest families that ever existed in America. So Cornelius Vanderbilt made his fortune in the transportation business. At his death in 1877, it was estimated that his family fortune was worth over $100 million. Which was more than the U.S. Treasury actually held at that time. If you were to translate that to today's times, his family would be worth about $200 billion. which easily placed him as the richest man in America. He ended up passing 95% of his wealth directly to his son, William Vanderbilt. And William started off doing great things with the money, but eventually the Vanderbilt family became known for their lavish spending. And there's nothing wrong with spending at all. The problem was they began spending more money than actual income they had coming in. And you don't need a degree in finance to know that's a recipe for disaster. And of course, they ended up losing it all. The Vanderbilts held a family reunion back in 1973. And of the 120 family members that attended, none of them were millionaires. So they literally went from the richest family in America to losing it all in just a few generations. And then you have the Rockefeller family. John D. Rockefeller made his fortune selling oil. He started Standard Oil of Ohio back in 1870. His business was refining more than 90% of the oil in the United States. And as a result, he then became the richest man in America. He ended up dying in 1937 and had amassed more than $1.5 billion. In today's dollars, that'd be worth over $340 billion. And his son, John D. Rockefeller Jr., inherited the vast majority of his wealth as well. So these two stories almost seem identical to each other. But here's the difference. John Jr. made a decision to keep all the family's money together. And little did he know that decision would completely change the legacy of his family. And he kept the money together by utilizing what's called a family bank. And this family bank is how the Rockefellers are still one of the wealthiest families in America. It's estimated they're worth about $8.4 billion. And that's while still donating $50 million a year to charity. And those two family examples are really important to understand because it gives you a chance to choose which direction you want your family legacy to head down. So now that we've talked about the why, now let's talk about the how. So here are the exact steps you need to know in order to create a family bank. The first thing you're going to do is create what's called a family office. And this will be a group of trusted advisors that will help your family maintain and grow their wealth. And this doesn't mean you have to go out and hire some expensive wealth advisor or something like that. Because again, the goal is to be as smart as possible with this money. So just figure out who's going to be the family's tax person, their investment person, their insurance person, their estate planner, their realtor, and any other area that may have a financial concern. And the overlap of those individuals helps make sure you always make the right financial decisions. Next, you want to put together a family constitution. This step is extremely important because this is where you set the guidelines for your family bank. And all future generations will have to follow those guidelines. And your family needs to understand that just because they are family does not mean they get guaranteed participation to this family bank. So you'll set up certain philosophies and values that must be maintained by the participants. You can include educational planning, which ensures that the younger generations learn about life, money, and wealth while they're still a child. One common principle that's used a lot is a family retreat, where the older generations teach the younger generations all these different principles. The Constitution will also dictate how money gets used. It could be for things like entrepreneurship, education, real estate, or other personal family situations. Then you want to create a family board. These are going to be various individuals that collectively decide whether someone can borrow money or not. And those decisions are based on a majority vote. But of course, you must maintain an odd number of board members to make sure there is somebody that can always be a tiebreaker. Then you move forward with establishing your trust. This trust will be your family bank. Now, the money that's going into the trust typically comes from a life insurance death benefit that paid out, the sale of a property, the sale of a business, a lump sum of money that's currently sitting in another account, or gradual funding during your lifetime. Traditional estate planning typically passes a lump sum of money to individuals with little or no conditions at all. But this entrusted planning focuses on giving your family the ability to replicate wealth versus just spend through the wealth. The goal is to make sure your family doesn't start over every generation at ground zero, but instead it will allow them to leverage your legacy to help them get an edge in life. And this method isn't about controlling everything from the grave, but rather give them the opportunity to tap into the family bank if they plan on doing the right things with the money. Next, you're going to have the trust purchase life insurance policies on all the participating family members for the highest amount possible. Now, it can't be any type of life insurance policy because the strategy won't work. It must be cash value life insurance. The first reason is because cash value life insurance allows your money to gain compound interest. And that's important because you always want to park your money somewhere that's going to be working for you versus having it sit somewhere getting little to no interest at all. These policies also allow you to take out policy loans on your own terms, which means you don't have to worry about credit worthiness or anything else that typically gets in the way of getting a traditional loan. And these loans usually have favorable interest rates. And some policies give you multiple options. And while there is an outstanding loan, you still gain compound interest on your entire cash value. However, the most important part of utilizing this specific type of life insurance policy is the fact that there is a permanent death benefit. And because you will have money constantly flowing in and out of your family bank, there's always a risk of someone not paying back their loan, whether it be for reasons within their control or out their control. So there is no guarantee that all the money the family bank loans out will be paid back regardless of the person's intent. But the one thing that is guaranteed is that no one lives forever. So when those insurance policies were set up, the trust was listed as a designated beneficiary. So that means upon someone's death, the trust will always be replenished back to what it was before it loaned out the money. But in most cases, it'll be a lot more because the death benefit is generally larger than whatever the loan was. And that death benefit pays to the trust 100% tax-free. And that right there ensures there will always be money available for the following generations to come. So mathematically, the trust will never be depleted. So now you have a clear understanding of what the Rockefeller family actually did versus what the Vanderbilt family failed to do. And now you can determine what you want to do for your family moving forward. Thank you guys for watching, and let me know in the comment section what you guys think about this strategy. And don't forget to hit the subscribe button for more financial content. And I'll see you guys in this video next.